Hey everybody, happy Sunday and welcome to our weekend event, Adapting to a Changing Market. Let's jump into today's agenda with our 9 special guests going over how they adapted to this changing market in quarter 1 and how they used TrendSpider to do so. Starting with Rob Smith, then we have ThetaWarrior, Magic Mike, Jeremy Newsome, Market Traders TV, Jack, aka Alpha Charts 365, Anne Marie Bain, Options Mike, and Peter Hegedus, founder of the Traders Path. So sit back, relax, and let's see what they have to say about how they got through the last couple months.
All right, thanks a lot, Jake. And hello, everyone. I'm Rob Smith, the Smiths in the Black channel at Ticker Talker here. Today, going to talk a little about what I call the Strat. Hashtag the Strat if you're on Twitter. It's short for the strategy. And it's basically something that I came up with a while back and to simplify trading, because a lot of people start off trading and they get confused. They don't know what to follow. They don't know what to listen. They don't know why things happen or what to look for. And by the time they figure it out and are attempting to use multiple indicators and different markets, oftentimes people get confused, flustered, and give up and blame themselves that they weren't working hard enough. So what I've done is I've simplified things so you don't have to think anymore. You'll know exactly what's happening. So if we go to my screen here, what you're going to see here is these are monthly candlesticks, all right, of the S&P SPY, right? That means that each one of these is a month. Okay, represents a month. Now, anytime it's red, that means it closed down here, right? It opened here. These are the range outside of the wicks here, are the range outside of the opening and the close. This was the open. Let me get my, let's see. Here, this was the opening, and this was the close. All right, so you can see that was red and down, right? And so what we look for here, and just a couple of things to make it very simple, all right? This tells you the direction the price is going, right? If this is red, it's going down on the month, as far as we know, which means sellers are hitting the bid, right? They're not waiting on the offer, they're hitting the bid and driving the price lower. So this is a monthly chart. I actually use yearly and quarterly charts, but for the basics of the strat, we want to use 4 major time frames: the monthly, the weekly, the daily, and the 60-minute. Now, why would we do that? Because what we're doing is we're identifying participation groups by price and time, right? What are they doing, right? So on a monthly basis, you can see this here. They're selling. The sellers are more aggressive. They're hitting the bid on this thing, right? So at any given week, if it's red on the week, not only are they doing it this month, they're doing it this week, right? So then we go to the daily chart, and if that's red, they're not only selling it this month, this week, but they're selling it today. And then we can go down and look at the 60-minute. And if they're doing it on the 60-minute, they're doing it right now, right? That's called time frame continuity. It's a very simple way to understand what you're looking at, because a lot of people are taught to buy old versus old lows and stuff, or what have you. And if you're doing that, when everything's red, you're going to get destroyed, all right? That's a problem, all right? So when things occur matters, right? So there's a difference between something happening on a Monday or a Friday afternoon, right? So we want to have all these time frames lined up, right? Always, right? And so there's other things that you can look for. You'll notice on my chart, which is on TrendSpider, has all my signals in there for you. You're going to notice this says 2 down. And this says 2 up. So the important thing when you pull up candlestick charts is to understand that there's only 3 things that can possibly happen from one of these bars to the next bar, okay? Once you understand that, you're gonna know what's going on. You don't have to think anymore. You'll notice this says number 1 on it right here, right? That's a scenario 1. So there's 3 possible scenarios. What that means is a 1 is a consolidation. It wasn't strong enough to take out the high, nor weak enough to take out the low, right? That's true. 2 takes out one side of the previous bar. You'll see this says 2U, 2 up, right? Here's an inside bar and then 2 up. The other type of thing that can happen is one of the most important things you can know. The outside bar, 3, takes out the high and the low of the previous candle. That's very important because that's how you're going to gauge magnitude. How far is something going to go? A problem a lot of traders have is not knowing how to gauge their magnitude. And the way you can know that they don't know that is when they say that they bought something and then as it's going their way, continue to sell it, right? Because they don't know how far it's going to go. You want to be able to gauge your magnitude, and these threes are going to help you do that, okay? Now, there's only so many ways that price will continue or price will reverse, right? Based on what I just showed you. And there's going to be a few more ways that I'm going to show you today, but just to keep it very simple, okay? You're going to see this. A 2 up took out the previous high. 2 down. That's a reversal. 2 up, 2 down, right? Now you can also go 2 down, 2 up, right? So just 2 in one direction, 2 in the other direction, right? That's a reversal, right? That's what a reversal looks like. If you know that, you don't have to ask anybody, is it a reversal? It is. And they can highlight that on the charts at TrendSpider. Another way price reverses is this. A 2 in one direction, this is a 2 down, followed by a 1, followed by a 2 in the other direction. It means they hit it, it consolidated, and reversed, all right? You have to, it's reversing this down move, all right? Another way the price can reverse is the 3 itself, because it was a 2 up at one time. But then once it comes back through here, now it's a 3, now it's an outside bar. It's important because it tells you that the buyers were aggressive enough to pay up and the sellers were aggressive enough to pay down, right? So when we look at stuff like this, you're going to notice this was pandemic, right? Did we know about that? We sure did. As soon as this changed continuity, we knew there was a problem. We knew there was a problem, all right? There was no surprises here. This was going to go outside of this. We knew that for sure. And then hopefully you take all this stuff out with you, which you did. So you're going to notice this is a 2 down, right? Did we know about that? That's how price continues. A 3, then a 2. A 2 is a continuation, right, of this, because they rejected the buying up here, right, got slammed, and then hit it again here. This rejection was still occurring in here, right? We knew that, all right? So we weren't surprised by the pandemic slammage, all right? We knew that. Then what happened? A new month. This also happened to be a year ago in April. That's a new quarter. So as soon as this thing goes green, you have time frame continuity back to the upside. I'm going to tell you right now, this slammage happened over the 200-day, and this happened way below it, right? So if you're doing that, you're way late, all right? So as soon as this goes green, it's green on the quarter, it's green on the month, it's green on the week, it's green on the day, it's green on the 60. Guess what's going to happen? The price is going up, okay? Then what happened? Then the 2-1-2 reversal here, all right? And so for longer term accounts, what you're going to see is that this can keep you in. Still good, 2 up. Still good, 2 up. Still good, 2 up. 3, now you got some problems here. You would know to take profits or protect yourself with puts, right? As it goes 3. Then what happened? Inside bar, consolidation. Anytime you see a 1, you want to know about the 2 because the 2 is coming. It has to eventually. And so here, you'll see this. 2 up, 2 up. Got a little risky in here, but stayed 2 up. You needed to protect yourself, but it didn't go outside. 2 up, 2 up, 2 up. Still good, right? So we've known that the whole way up. And so by knowing just what I've been showing you and sticking with some longer term charts, you're going to know what happened. So if we go to QQQ, QQQ. So you can see a reversal of a reversal. This is what we look for a lot of in a continuation pattern. You'll see this was a 2 up, but came all the way down on the month. 2 down, right? So here took out these 2 became an outside bar of that, right? It's important to understand that charts are only going to present a time frame the way they want to. If this was a 2-month chart, this would be a 3 of these 2. Correct? It's true. So then once you got your 2 down, 2 up reversal here, this month, we knew about that. We're looking to take this out because then these 2 months become an outside bar of that, right? This is very important stuff and it's not that hard because it's right there for you. 2 down, 2 up. As soon as it took this out, we knew exactly where it was going. It was going back to the highs, which it did. So when we knew that, then we could look at, say, NVIDIA. Boom, 2 up, 2 down, stop all these guys out. Boom, right here. As soon as it took that out, we're going into the highs. NVIDIA. I actually did another webinar with Jake last month, and he said, maybe you could bring us some monthly charts. I said, yep, sure can. Space. I said, here, 35, below 35, you got yourself a 2 up, a 2 down reversal. Boom, boom. Where's it going, Rob? I said, below here, 22.88. Like from 35? I'm like, yes. Yes. Like, it looks like I did it 2 months ago. These 3 months became an outside bar of space. So not that hard. And especially when you use the longer term charts, because that narrows your universe and say, I don't want, a lot of traders fail by watching too short term of a chart. They only look at daily charts, right? They have no clue if they're trading a 1 on the week or a month. That's something you're going to want to know about because it's consolidating. And this is how you catch these major reversals. So if we take a look at Amazon, you're going to see this 3 month. That's something you want to know about because they were willing to pay up and sell down. And then boom, 3-2 down. Stop out all these guys. And then boom, 2-2 reversal back up to be an outside bar of this. Did we know about that? We sure did. All right, all month. So you had all month to go after Amazon, knowing it was going to take that out, because that's how you gauge magnitude. So a lot of people in the Reddit world want to know about GameStop. All right, you want to see something? Look at this 2 up month. Right? I knew about that the whole time, right? And then when you have this up into here, things would change on the week, stuff like that. And then what happened? You had a new month, puke, February, right? Then you had this, right? So you got that slight 2 up here, but because it was so volatile, you can take it down. Now you've got your inside month. That's why it's doing nothing. And then if you go to your weekly, you're going to see this. What's this? Is that a 2 down, 2 up reversal on the weekly? It is. That was over 53.50. Thing rocketed off of that. And we know about that. We sure did. Then an inside bar. Either side of this baby I want to know about because that's going to be my next 2. 2 up, boom, right back up, right? And then you'll see this 1 here on the weekly and starting to 2 back down and all this kind of stuff. So just by watching some of this stuff, you'll know, what you're looking at. And if you go to gold right now, gold on the month, GLD. What's it doing? That's a 2-2 reversal. Yeah, that's that. Do we know about that? We did. And that can help you to narrow down your universe even further and say, okay, what about the stocks themselves? GDX, what are you doing? That's a 2 down, 2 up. And these 2 become an outside bar of that and hopefully more, right? So then you can look at all the stocks and break it down. So something you want to see is a high concentration of 2s in the same direction in any given sector. So what I'm going to tell you right now, I can scan and tell you what the market is doing without looking at a single chart. The market's going to trade in the direction of the most 2s, time frame continuity, and failed 2s going 3. It has to. It doesn't have a choice. So all I have to do is scan for that on all these different time frames. I know exactly what's going on. Right? Then it's down to finding these compound 3s, which are a little more challenging, but you'll see, and knowing what's also in certain things. So you're going to see your Microsoft. So we know about this. Did 2 up, 2 down, boom, into the highs. And that tells us to watch XLK. XLK. Oops. XLK. Why? 2 up, 2 down, boom, into the highs. Microsoft and Apple are 50% of that. That's something you need to know if you're trading ETFs. What's in there, right? And so you see Apple right now is 2 down, 2 up on the month. Still hasn't taken this out as yet, right? So we're still keeping an eye on that, although we're running out a month. If we go to another one that I did with Jake, Triple D. Here. The 2 up, 2 down month. Did we know about that? Yes, and still going. And one of the things you also want to look for is when you're watching shorter term time frames, how is it going to relate to what's going on in the bigger picture? What's everything going to create? Trading should be like, when you're looking at charts, like playing pool. All right. You don't just go in there and bang the ball into the pocket. You leave yourself another shot, right? So here you're going to see on the weekly, the 2 up, the 2 down, boom, right? It fell apart, right? And then you wait for the 2 up, 2 down, and you're back in on some more here after you have that green here, right? And then you can ride this into the sunset all you want. But if this works, this 2 down week, it's going into here. It's going to create the potential 2 down month, which it did, and is still going on a monthly basis, triple D. If we go to Adobe, in Adobe here, outside month, right? 2 down, 2 up. These 2 became an outside month of this. We've known about all these all month. And I make videos, so I mean, everything I say is pretty much recorded. And it makes sense because it's stuff I talk about every day. So if we go to today, and we look at a daily of PLBY, okay, here's what you're going to see. You want to be coming back through a previous range as opposed to going straight into new highs or new lows. And the reason you want to do that is you want to have stop people out. That's what causes things to move faster. All right. So anybody short this thing, gonna be short against this, gonna be short against this, or some guys saying, I'm gonna be short against the all-time high. Boom, 2-2 reversal. These 2 became an outside bar of all this. That's just today. And if you look at Oracle, if you want to go the other way, here, 2 up, inside 1, 2 down, real nice, okay? Then if you go to look at, say, Tesla, what happened to Tesla today? Tesla went 3-day. So once this thing starts going green, I'm looking for signals to take this thing out, right? And go outside day, which it did. If you go to your 60-minute, what happened? First of all, it opened the day here, 2-2 reversal on the 60, right? If it's going to be an outside day, that's what it's going to look like. You can take that right here, all right? Then you go inside, then you go inside, and then boom, 2 up, 2 up. So there's your consolidation after your reversal and your continuation to become the outside bar. If you go to the 15-minute, like I said, you're always trying to use these multiple time frames to time your entries. Here, you see this? 2 up, 2 down, and this was the bar that broke those inside 60s, those ones to the upside, right here. And then for the rest of the day, we went 2 and into heaven, giving me that outside day. You see? It's not that hard. So another thing that you want to do is keep a checklist, right? Because from what I just told you, I already know what winning and losing trades look like, okay? Losing trades look like this. Getting chopped up, trading an inside bar 1 because it's not doing anything. Fighting the direction of a 2, right? Getting slammed by a reversal on a 3, right? Taking out the lows and getting short. I'm gonna get short as soon as it takes out that 1. Boom, destroyed. And time frame continuity against you. Winning trades are favorable 2 in your direction, favorable 3 in your direction with continuity, right? And time frame continuity in your favor. That's what they look like, okay? So if you can go back through anything you do, and you're gonna find out that that's true, right? And so that's why you always want to be trading in the direction of the 2s. And when you're looking at a market or you're looking at a sector, you want to see how many things are doing that. That will tell you what's happening. So there's something we call a simultaneous break. And that's a high concentration of 2s or failed 2s going 3, either in the market or in a direct sector. That will tell you exactly what's going on. And the good part about that is it tells you have institutional activity, that they aren't just buying one stock. They're buying everything in the sector, right? And you'll know that by the ETF. You'll know that by the broader averages, SPY, diamonds, Qs, all that kind of stuff. And that's a good thing. That means you can look for setups in any of the stocks, and then move your stops up. And the one that by the end of the day or the end of the week or however long that period is, all you're left with is the strongest to the upside because you got stopped out on other things. So one of the important things about risk management is your stop, right? Where's your stop? Because one of the things I just showed you is how to gauge magnitude. Most people don't know how to do that, right? When this 2 down goes 2 up, this thing's going to take that out at least, right? When I got continuity to the upside on all the other time frames, every reason to believe that's going to work, right? So when I talk about trades, there'll be 2 things that I say. The problem with that is, or every reason to believe that's going to work. And where's it going, Rob? Up there, right? That's what you want to have. So when you understand what I just told you, your confidence goes through the roof. So if here's another one that was recently really good here, Futu this week. And you're going to see this on the daily chart. Look at this, right? Look at this. 2 down, inside, 2 up, rocket ship, right? Then what happened? Boom, 2-2 reversal the next day. This thing got murdered. Good on the upside and the downside. And if you go to the 60, right? I usually start people out usually 30 and 60 minute time frames because it takes a while to set up. You have time to look for things, right? And let me see if I can get this. So here was that launch day to the upside. So let's say you're not going to grab it right here because it's just taking off. You wait for corrective activity. That means one of these reversals against it, but then you wait for that reversal back in the direction of all the time frame continuity here, right there. There's your 2 down, 2 up. Futu blasted from here. It was like 156. What's this here? 150 over like 163, and this thing went blasting up to 173. Boom. And then you get that reversal on the day. All right, and that was a little quick, but you can take that one that took that daily down. Here, that's a big reversal. These guys, and there's nobody who's short after this, right? Pretty much, right? Carried them all out. And then you can stay long, but then they did a secondary. If you stayed long, you're going to need to jump ship, right? When this thing gaps down into here, right? But here, the reason this 2 down is important right at this point, right where it takes it. This is where everybody goes underwater, right? Everybody who bought in here goes underwater right there. That's what I want to know about. It's like a collapsing porch. Everybody's going down, right? And so what we will do, because if we know this stuff, we also know that 3s exist, right? If a 2 fails, as we use extremely tight stops, they should just go, right? When I say there's every reason to believe that's going to work, it should just go extremely tight, oftentimes pennies, oftentimes by time, 1 Mississippi, 2 Mississippi, this should just go, right? Why is this not going? When the porch collapses, this thing, everybody should fall apart, right? And then you can move your stop using shorter term charts. And so let's say that I want to go to like that 60 again. And just say, okay, here's where the porch collapses. And I'm going to stay even, but I'm going to let that hour go out. And I can just walk it down the highs of the hour. Here, 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 still in all day long on that. No higher high on your 60. Then when you come in the morning, boom, 2-2, taking my profits right there. And you can even reverse on that because on this time, the day is now green because it's a new day, right? The day and the 60 are now green. And the reason you can do that is because you're playing with house money, right? Normally we wouldn't pick this because of the other time frames, but you can do that to get a little bit out of it here. And then it's this thing bails a little bit on this thing, just take your money and off you go. Because one of the important things that people also don't realize is that once you know what reversals look like, that when you're getting out because of one, you reverse. You reverse. Have you ever heard people say, oh boy, I got out of that one just before it tanked. I'm like, hello, get short if it's going to tank. Well, I don't know if it's going to tank. I'm like, is that a 2-2 reversal? Yes. Then it's going to tank, right? And if it doesn't, get out. But if it does, you made money on both sides, right? So you always want to be aware of being able to do that. Now you will, because if you use the TrendSpider software, it's going to be clear as day what's going on, right? When you have those 4 time frames up there, I'll have people that won't touch anything that doesn't have full time frame continuity. There's a little bit more to it when you can go around, say the control group is 60 in the daily. But I'm not going to get into that right now because I just wanted to do a basic overview of what you can do with this software that will tell you what is happening. You don't have to guess anymore. You don't have to put indicators up. What is going on? Just simply by looking at the color of the candles and the number of the candles and knowing what reversals look like, which are in the software itself. So I think that's pretty much going to nail it down for today. Always enjoy coming here on TrendSpider and talking to new people and showing people this because of its simplicity. It eliminates a lot of the noise that people have problems in trading. So at this point, we're recording this, so we're still 2 up as far as we know, and we just started a new quarter. So one of the things you want to know about is when you listen to this and you pull up your TrendSpider charts, right? Where are the 2s, right? I'm going to go back to the SPY for just a second. And we'll go back to that monthly. Because when people are always nervous, I'm like, oh, I think the market's going to crash. I'm like, do you? You don't have to think that way anymore. SPY. Nope, let me get SPY. You don't have to think that way anymore. You'll know. What's the next 2? Is this anywhere near 2ing down in the month? No. If this market's going to tank, that's what it's going to have to do. Or go inside in May, or poke above this high and then come back and go 3, or go 2 up and 2 down, and that's it. It's got to do that. And if it's not doing this, the market's not tanking because that's not a major signal. And you're going to get stuck in noise when you do that. So we always want to try and start on the longer term because then it tells you to nail it down to the shorter term. You know you already want to be involved. And that's when you catch these big moves like I just showed you in a lot of these NASDAQ stocks. So I think I'm going to leave it right there. Jake, thanks for having me. And I think that's going to do it for today. All right. Good night, everybody. Thanks for listening.
Alrighty, a big thank you to Rob Smith for teaching us about the Strat and how he uses this in any type of market. Next up, we have ThetaWarrior to go over his strategy and how he's been able to navigate the markets over the last couple months.
Hey, Jake, thanks a lot. I appreciate it. ThetaWarrior here, going to go over some charts and talk a little strategy and kind of give you guys some insight into how I like to trade and how I approach things. The first thing, great case in point, we'll look at Tesla here, has been a real fun stock and a big winner, a really fun one to trade just because it's known to be super volatile and it has had great follow through, not so much over here, but it has been a really fun stock. The main thing that I focus on is consolidation. As a trader, I want to find spots like this where, volatility is getting low, people are getting bored, and the stock is just, basically trading sideways. And when you get a move like that and it starts to come out of this range, that's when I, hop in. Sometimes you get fake outs like this, that's part of the game. I think that's why it's important to always use a stop loss. I'm really an advocate of that because you never know, this could come back, 50, 100 points, who knows, while you're waiting for it to rebound. The thing that I always remind myself is you can always buy back in. And if you get stopped out, you get stopped out. The market will sometimes do that. Doesn't necessarily mean anything was wrong with your strategy. Just, the way of the ebb and flow of the market. So like I said, I look for consolidations like this. Not really too concerned in which direction it's going to go. I am basically just looking for volatile moves. I look for, explosive moves out of long periods of consolidation. The price action is going to be the first thing that clues me off to something might be coming. Then I look at indicators like the MACD. I focus on different moving averages, the 8, 21, 50 SMA. I use other volatility gauges like Bollinger Bands. You know, when the stars align, that's when I want to be in the trade. Little, you know, drops like this up and down, you know, these can chop you up. And I don't want to be in the trade, you know, during this period. So this is what I look for. You don't get them all the time, but they do come about. And that's like my big strategy, is to just be patient, you know, let the trade come to you. Don't ever try and force a trade. Of course, you can make money in this if, you know, you just do quick scalps, but this is where the real, you know, this is where wealth is built. This is where you can really make a huge percentage gain on your portfolio. So that's the gist of my strategy. I look for breakouts. I'm a breakout trader. I stick to a few, you know, different, very small amount of patterns. You know, I like triangles. I like wedges. I like cups. Anything that basically is going to get an explosive move out of it. You know, that's what I want to be in. Another big part of my strategy, I kind of touched on it, is to just be agnostic in which direction the market is wanting to go. As long as I get a move, I'm fine if it goes down. I'm fine if it goes up. I think that it's important to separate your mind from being an investor and being a trader. Like, for example, Microsoft. I love this stock. I own a lot of it. It's been a huge winner, and I'll continue to own it. But if I see something bearish and I think it's topping out, you know, and I put on a short position, I hope that that thing tanks in the meantime. And, you know, I know over the long run, it's going to be fine. So I'm looking for short-term moves, you know, volatile moves in one direction or the other. And like I said, you have to be able to separate that in your mind. You're not an investor when you come out here and you buy, you know, a weekly put option. You're a trader, and you can't get the two twisted. And if you do, you know, it can trip you up because you have the emotion of thinking, well, I hope this is going to recover, and I hope that it's going to bounce soon, yada, yada. And you might miss this huge move right here that could be a big, you know, capital winner. The way I look at it is, great. If I'm right to the downside and I make money on the put, I could put that money back in and buy more of the stock, which, you know, I've done that many times. So that's kind of like a beautiful symmetry, I think, that you get with just experience in the market, because I definitely did not have that type of thinking when I first started. I was only buying calls because I only wanted, you know, things to go up. And I realized that I'm missing out on a huge percentage of the move, or, you know, the moves in the market, you know, not capitalizing on the downside. So I made a change of that, and that allows me to be super versatile and, you know, trade any market condition, basically. The only type of market I don't love is sideways. You can certainly make money in a market like that, you know, selling premium. Of course, volatility comes down, so it gets hard doing that even too, but it is possible. But for me, I like big moves up, big moves down. Either way is fine. The only goal is to make money, and these tickers are just letters and numbers. You know, I don't look at them from a fundamental basis. Microsoft is a great company, has great growing revenue, a great management team. I know all of that. But as a trader, it's just price. All that matters is price. That is the only thing that I'm concerned about, and how I can make money, you know, in the short term, capitalizing on a move. So this is another nice example of a consolidation here. You know, it's just chopping around, chopping around. Obviously, you've got a trend line that connected right up there. I don't have it drawn. We'll just throw it on real quick. Sometimes they give you fake outs like that. It's funny how they'll do that. They do the fake out and then the shake out, and then they do the real move. That's another part of, I think, just being in the market long enough is seeing these type of things. You know, you get stopped out right there. Okay, put you back on the watch list. Then you get in back here and you can actually catch the move. So that's another part of it, not giving up on the trade. Getting stopped out is fine. Everyone gets stopped out. sticking with it and still believing in your thesis. I think that's what separates the boys from the men, so to speak. Because if you've given up, you've gotten upset, right? And you forget about it, you miss all of this. So forget the emotions, leave the emotions at home with your family, your kids, whatever. Out here, this is 100%, technical trading. That's how I approach it. Don't let the emotions, take over you. Over the past, few months or so that we've gotten in this year, the market has been chopping around a lot. Big tech is a great example. The way that I've kind of tried to, avoid getting chopped up is I've really shortened my time frame. So what I'll do is I'll stay in a trade for a day or two versus, in 2020, 2019, I might be in a trade, for 3 to 5 days. That was kind of my sweet spot. You could catch a nice move in there. But with a lot of this up, down volatility back and forth, one way that I've been kind of managing my risk is doing a little more scalps, get in and out, try and be done before even the close is ideal. It also really helps when you're, going to sleep at night and you don't have a huge position on, and something crazy can happen overnight, because obviously options, you can't trade them pre-market, aftermarket. The biggest and most important thing to me for managing risk is to use a stop loss, and not a mental stop loss, a hard stop loss. So the first thing that I always do after I put on a trade is set my stop. And I set my stops based on levels. Some people prefer to do it based on a certain percentage of the contract, which is not a bad thing. But to me, it's more important. Let's say if price, falls below a certain level, if I'm bullish, this is the breakout level here, let's say, and I buy the call, I want to get stopped out there after it fails to bounce, right? So I'm stopped out here. Obviously, it comes down a little bit farther, and then boom, I'm back in the trade right here. So I base it off of a level. But like I said, the most important thing I think is using a stop loss. Don't afraid to be stopped out. Everyone gets stopped out. If you don't get stopped out, you're going to lose money. So what's, more important, hanging on to your money or being right? Doesn't matter about being right or wrong. It only matters making money. Another big thing I do to manage my risk is to use theta combative methods of trading. And that's by using spreads, butterflies, things where, I can sell a little bit of premium in the position. And that can really, really be beneficial. Let's see here if I can come up with a quick example. The best thing that I like about spreads and why I use them all the time is if a position moves against you, there's things that you can do to kind of work your way out of trouble. Like, for example, let's say Google consolidating a really nice rectangle here after making a high. You buy this breakout, you're thinking, yes, this is it. We're going to go to the moon now. And, second day it kind of gets shot back, down here, you're really thinking, man, I screwed up. What you can do is, I think in this position, I had like the 1850, 1900 call spread, or the 1875, 1900. So like I said, first couple of days, you're feeling great. Then it pulls back on you. If you were just long that naked, 1875 call, you're going to be in a lot of pain down here. But because it's a spread, when it pulls back, that short 1900 call that you have is protecting you in a way. So one thing that I'll do when the trade moves against me is I'll buy back that 1900 call. I'll buy back the short position and basically hope for a bounce. If you don't get the bounce, you're in the same position you were anyway. In this case, it didn't come quick enough. I think I just took the stop when it fell back in this rectangle. But let's say I did get that bounce. I bought back that short 1900 call, which made money on it. Then, you're lucky enough, you get the bounce. Then you're naked that 1850. So you have a much bigger delta move in that. So you're making way more money than you would have in the first place. At that point, you can either let it ride naked, or you can then sell that 1900 again, possibly at a credit. And then you have the position on for free. So I'll leg into things, I'll leg out of things. Spreads give me like a really, better approach, I think, than being naked. There are times when you absolutely want to be naked, I think, when there's like a big explosive volatile move like this day. I just had a ton of naked calls. That's the type of time I think then that they're best. But most of the time, you're looking for a move to occur over the next week and a half. I always will put on a spread. Much easier to manage if it moves against you. Another thing, like I said, is the butterfly. I put on a lot of butterflies because they're so cheap comparatively, and they give you like a really wide range to be right. Like for example, Amazon was one that I did recently. I think I was going after the 3,200. It was just about a week or two ago. I had on I was short the 3,200 call and long the 3,250 and short or long the 3,150. So it was a 3,150, 3,200, 3,250 butterfly. And I think I put it on for like $3, $3.50 or whatever. So you've got $50 wide that you can make money in either direction. So $100 total, and you're paying $3 for the position. So the risk to reward on butterflies is amazing, especially on a lot of these big high flyers like Amazon, where, an at the money call can be $50, same day expiration. It's crazy. So butterflies are a great way to manage risk and to combat theta. That's huge for me. Another thing how I manage risk is I'm never afraid to take a profit. You cannot be afraid to lock in gains. If you don't lock in gains, the market will eventually move against you. And, the worst thing ever is to see a trade go from green to red. Like that should never, ever, ever happen. When I'm in the profit zone, I'm continually moving up my stops. First thing I do is, I put them to whatever loss I'm willing to take on the trade. As it's working, I move it up to break even. Then as it's continuing to work, I move it a little bit into the profit zone. I'm continually pushing up. The other thing that I'll do when I think that a trade is getting to resistance, like let's say I'm long here and, I'm looking for a move over this level right here. But I think potentially it's going to hit some resistance. What I'll do is I'll throw on a trailing stop, because a trailing stop will allow you to stay in the trade, but it will also protect you on the downside if it does decide to pull back, which they do. It definitely is a minute thing, getting it to where it's the right spot. You don't want it too wide. You don't want it too tight. Trailing stop, I think, just takes practice figuring out where it's going to go. And you also have to know your stock, because Amazon can move, an option contract can move $5, $10, with a, not very big move in the stock itself. It can be pretty volatile. So you have to kind of base it on the stock in the situation. But a trailing stop, you'll never, ever, ever sell the top, right? But you will likely stay in a trade a lot longer than if you, like, let's say you just had a limit order right there to take you out 33, 35. Well, then this thing blows through and, comes all the way up to 33.72. You just missed out on all that. Certain times it's going to pull back and it's going to stop you out down here and you will have to give up a little bit of profit. But other times like this, it'll blow right through and it'll, you might stay in the trade for another $20 or $30 or whatever. So that's huge. Stop loss and trailing stops. Those are like my go-to. If a stock moves against you, position moves against you and you get stopped out, so be it. That's easy. Honestly, I never have problems cutting losers, because the way I look at it is I don't want any losers on my bench. I only want winners. I only want winning positions that are making money. The rest I have no time for. So taking a stop has always been easier for me. The hard part for me has been like, where do I want to take profits? So that's why I do it periodically. That's why I do it just under, resistance, I'll put on the trailing stop just under resistance. So things like that I can make it like methodical. That has been really helpful. Again, taking out the emotion aspect of it. One thing that has been, difficult in this last market, like I kind of touched on, is just all of this chop. You might get long, you're chopped out, you immediately get stopped out. You can't let this deter you from, catching the move. I remember this right here started looking like an inverse head and shoulders, right? You can see it. This breakout here stopped me out. I think I bought in on this move thinking it was going to run. I get stopped out, whatever, it sucks. Get right back in the next day when it pushes back above this neckline, and boom, caught all of that. So I think that you have to keep your eye on the prize. If you get stopped out, if you make a mistake, so what? Forget about it. Everyone makes mistakes, right? The market does not care about you or your mistakes or anything, right? This is, a dog eat dog world, and you have to go out there and you have to make the trade, and you have to be mentally tough to succeed. So I think that, if you get stopped out, you make a mistake, whatever, put it behind you, keep your eye on the prize, and, don't miss moves like this. Another big thing, you got to keep your losses small. You don't want to be over trading, all the key things that, you're always told and you're taught about. Those are really important things. I think it's good to be patient. And, if you have, a bullish thesis, don't let some idiot on Twitter, convince you otherwise. Don't let, one bad day shake you out of a trade. Maybe, that's just the market, getting rid of the weak sisters before, the real move actually comes. So like I said, you got to be really mentally tough to excel in this, I think, and never, ever, ever be afraid to take a profit. Got this explosive, beautiful move right here. People that missed it on this day are chasing it here. And of course, comes up to the high almost and pulls back. They crush it. So all of these people chasing up here just get annihilated. The market will do things like that. That's why you never be afraid to take a profit, because imagine if you had held, and then it comes all the way back down here and you just get crushed. I mean, there's no worse feeling. So take profits. That's what experienced traders do. Don't ever be afraid to take a profit. The other thing I really am adamant about is my levels. I don't have a lot of levels on these charts. Let's just pull up Apple, for example. I always go back to the charts. I start with the charts and I go back with the charts to determine where I need to get in, where I need to get out, where I should be concerned. Maybe there's sellers approaching. It all comes down to the levels. That way it's a strategy, it's a plan. I have something, written down and thought of, and, that way I'm not, just a gunslinger in the action, trying to buy a call, sell a put, whatever. I have a strategy. I have something that I can fall back on, and that will honestly keep me in a trade too. Because I have done the analysis and I've done the research, and it helps me stick to my guns. Can't ever bring feelings into this game. It is all mental. It is all just numbers. It is, something that will crush you if you let it. So always got to stay, very on top of things. Quickly, we'll look at a couple trades that I did recently that were good learning experiences, a couple of them. Let's just pull up Etsy really quickly. So Etsy, nice consolidation, kind of has a diamond look to it, but had a nice triangle, after a long breather, after this insane rip, starts to break out right here. So I'm buying calls, right? I think I had the 220, 230 spread. And what does it do? 3 days 3 days up, feeling great. 4th day, it gets crushed. So again, a benefit of having the spread on, I can sit through a little bit of this. My stop loss level was, I think, right there at the bottom of this candle. Just throw a quick line on it right there. So here I'm thinking, okay, great. We're going to get the bounce finally. So I bought back, I think, my short 230 call. And then sure enough, didn't get the bounce. At this point right here, I'm stopped out of my 220. So I'm flat on the position. Thank God I did, because look, sure enough, it comes back down here. But ironically met up exactly with that trend line, held it and bounced. And now we're back over that level. So I'm not in this trade currently. It was a loser, but I'm not giving up on it, because it held support. So you've got kind of a bull flag, type of consolidation building here. What I'd like to see ideally is a move, somewhere up in here, a check back, and then a bounce off this level again. And then that would be, something I'd consider entering in. Again, looking at the MACD, the different moving averages, all of these things are going to help confirm in my mind the volume, right? All these things are going to confirm in my mind that this trade wants to go higher. So it's always better to buy dips, in my opinion. So if you get moves like this and it does bounce, this can be a great buying opportunity. Sometimes they don't give you a chance, like Tesla will just break out and just explode higher. It's been known to do that. So that's why I always will enter in a position upon that initial breakout. But it is going to result in you getting stopped out. Sometimes it happens. So if you do get that check back, like we did with Etsy, that can be another great buying opportunity. And it doesn't necessarily mean that the trade is not working. It just means that it's shaking some people out. There's some profit takers. This probably would have actually been a great buying opportunity right down here. Obviously, you got that bounce. With so many tickers and so many stocks, obviously you can't catch everything. That happens. Another part of trading is you're going to miss out on some opportunities. You're going to miss some trades. You're never going to buy the bottom and you're never going to sell the top. That's what I always tell people. So to worry about it is just a fruitless effort, and it'll only drive you crazy. If you made a profit on the trade, fantastic. Be happy with that. If you made a loss on the trade, that happens. Learn from it, shake it off, go to the next one. Let's see. Another fun trade that I had recently was this Apple. See, this is where we've got this long breather downtrend and then boom, breakout. It did pull back and of course closed just under that trend line there. But, there was a lot of other things going on to suggest that it might be going higher. So I entered my position on this day here and didn't take the stop because it didn't close red. It didn't come down here. If it certainly had pulled back to there, I would have had to get out of it. But next day, gives me a light of hope that it's working out. And then boom, the thing just runs. So I think here I was long the 125, 130 call spread. I was rolling up a lot of the naked 123s, 124s. As it's getting up to resistance, put on the trailing stop. I'm looking for a move to that recent relative high. Boom, trailing stop gets hit. I'm out, make the profit. Next day it pushes through. I'm back in the trade, looking for a move to this high here. Of course, it gaps right up, finds support, and then keeps going on and on and on. So this was a huge winner. I mean, you can make a lot of money trading moves like this that come from, nothing. I mean, this stock has been, a dog, the last few months. It's been doing nothing. And then boom, it gives you one of these. So now we're consolidating, filled that little gap. Potentially this trade is setting up again. So, this is what they'll do. They'll give you a long period of gestation. They'll get a nice rip. Then you'll see like a little bull flag, a little pennant, a little something, a little breather. Basically, the stock is just taking a rest, which is good. Rest is always a good thing. Consolidation is always a good thing. Stocks need to pull back sometimes. Here's another nice little pennant that occurred that you got a nice explosive rip out of. So these trades are what I want to be in. There's no need for me to be in this. You'll just get chopped up all day. So this is what I look for. So, I have a huge watch list of stocks that I'm constantly watching, and I'm always looking for those consolidations. And those, when I find them, that's when I get excited. That's when I start planning my move. And that's what I, love about trading. One stock that meets that criteria is PayPal. We just had an amazing breakout from this consolidation here, a nice reversal pattern, huge rip, and then we have a bull flag coming. So you can see here with this excellent Trend Spider software, I've got an alert set, my bull flag breakout. We can look at the alert, I think, quickly. And, I've got a little note what I want to buy, on the time frame, yada, yada. So I'm going to know as soon as this goes, in case I miss it for whatever reason, I'll know exactly what to do. I get a text to my phone and I know exactly what I want to buy, what the strategy is, looking for a move up towards the top of that flag, 277, 278 or so. So this is a trade I think could be a big winner any day now. I mean, this, could have gone today. It might go Monday. Who knows? You've got a nice MACD touchback. What I'd like to see is kind of like a curl, very similar to like this right here. And this is actually a similar pattern, right? You kind of had a consolidation breakout and then a sideways, to downward slope. MACD comes, touches the signal, but doesn't cross over. And then boom, you get a huge move up. So that's what I'm looking for here. I think that could be a really sweet trade coming up. So I'm excited about that one. And then we'll do one more look at Wayfair. Wayfair has been one I've been stocking, quote unquote, for a while because we've got a massive and beautiful cup consolidation after just an insane rip. I mean, look at this thing. The March lows, $22 to $350. That's insane. I mean, this stock is a huge multi-bagger for a lot of people. And rightfully so, after a huge move like that, it needs to take a breath. So this is really good. This is a beautiful thing. The question is now, is it going to put in this handle, which it looks like it might be? Is it going to give us one of these? Or is it going to turn up at this junction here and then just go right up and blast forward? I don't know. But I've got my alert set. I've got my strategy in place. If it does want to pull back, maybe there's a buyable dip in here. But honestly, the trade for me in this situation is going to be to buy this breakout, which, as you can maybe guess from these two candles, I already have tried and been stopped out. And that's okay. It wasn't ready. I think sometimes stocks do this to give an analogy. It's like they are dipping their toe in the pool before they jump in. I don't know if that sounds crazy or it makes sense, if other traders can identify with that, but sometimes stocks do this. They test the waters. So Wayfair is testing this breakout right now. It's getting ready. It's going to be an explosive move, hopefully. Of course, the market could roll over and this thing could dump and this could be a giant double top. But right now, it looks like a really, really nice cup consolidation. So on a weekly chart, right? The bigger the base, the higher in space. That's what I always tell myself. So, easily this thing could hit 400, 420, 450 over the course of the next few weeks if it decides to go. So PayPal, Wayfair, definitely have my eye on them. There's so many tickers out there. I think you just have to figure out what works best for you and your strategy and stick to those. I like tech. I like volatile stocks. I like things that are really liquid. I can get in and out easily, and the spread is, not super wide. With Wayfair, it's tough. We traded some of that today, but you can combat that again with spreads. So lots of different ways to trade the same ticker. That's kind of my strategy. I look at the consolidations. I focus on being a theta warrior always, because theta will crush you if you ignore it. So yeah, that's my gist. That's kind of, in a nutshell, the strategy that I focus on. And that's how I try and remain profitable and keep my edge in this market. So It's been an absolute pleasure. I really appreciate you guys giving me the opportunity. Jake, I'll hand it back to you. And if you have any interest in following me or being a part of the growing community, my Twitter handle is ThetaWarrior. I welcome you to join. We have a great community of traders, and we're all about helping each other and focusing on being better technical analysis driven traders. So with that, I'll say cheers and thank you very much.
All right, great presentation by ThetaWarrior. We're looking forward to having him on more segments and episodes in the future. Now let's move on to Magic Mike, who's a longtime TrendSpider user, a great trader. Let's see how he navigated the markets over the last couple months.
Hey guys, it's Mike from Magic Tickers Trading. I do want to thank TrendSpider for giving me this opportunity to pretty much present my strategies, kind of what I do and how I make everything tick, I guess, for the market from my perspective. If you guys, hope you guys get some kind of useful information of what I got to share today. But I'll go ahead and just kind of give you a little bit of a background about myself, I guess. I started with OTC trading, which was over-the-counter stocks, pink current, plays, so, pretty much the trash bin of the stock market, but started there out probably 4 or 5 years ago, I guess it is. I've been in the trading world about 7, 8 years or so. But pretty much had the biggest struggles like every new trader ever experienced, probably working their way up, going from, the dumbest things to some of the, more light bulb moments that you have. I mean, it's a ton of light bulb moments. I actually, as you progress as a trader. But anyway, kind of worked my way up to big boards, started doing options, and that's where I'm pretty much stuck now. Now, I am doing a little bit of crypto on the side with the hot phases going on lately, but that's something, a new venture kind of, playing with a little bit on the side. But for the most part, I'm pretty much stuck with options. And but anyway, as far as what I do, I have a chat room of 1,500 plus members, a bunch of students that we teach in there every year. Other than that, I pretty much stream and live trade with them every single day, and it's kind of my job. It's fun to do. I enjoy it. But anyway, I'll give you a rough down, I guess, as far as what I do, what I've looked to as far as trading the market. Obviously, we know we had coronavirus last year, I guess February 21, when the whole market started taking its massive dump and everybody was wrecking their accounts. I've been through a lot of different phases as far as trading high volatile stocks, coming from the OTC of literally seeing, 100% runners to 100% dumpers to thousands percent gainers and stuff in a day, and play with a lot of high volatility stuff. But it was a cool different world, I guess, trading in that environment where things completely were off balanced. The biggest thing I can kind of tell new traders when they come with a brand new approach to the market is you have to have the biggest discipline by any means. Pretty much working on yourself is the most important part. I can present you guys all kinds of different strategies of how I approach trades, how I look at trades, but ultimately it's going to be useless without understanding yourself as a person, understanding your discipline, understanding your approach, making sure you stick to your rules. I mean, rules are there to protect ourselves from ourselves. Right now, we're trading in a very, I'm going to say, kind of a mellow market. It's not really extreme volatility one way or another. Obviously, we've had kind of some trending moves to the upside. Past 2 days here have been kind of red. But other than that, you've got to be versatile in this market. It's the most important part. Don't be stubborn. Stubborn is a common feature that we all have when it comes to playing with money, trying to make our approach on thinking we know where it's going to go. We know what's going to happen next, and we know what's going to do this. You're going to come up with a bunch of surprises. And I've kind of mixed my way of trading. I've seen a lot of different other people, how they, approach their trading, whether it's patterns, whether it's candle formations, whether it's indicators. I've kind of mixed all the worlds in some degree to where I've kind of, made my own strategies work for me personally. But I'll kind of break down a few trades and how I look at them, how I approach them, and what makes sense to me. You guys never should just jump into something that doesn't make sense. You have to pretty much have a confidence for your trade, because without it, you're going to be hesitant. You're going to have emotions flare up. You're unsure about your targets. You're unsure about your stops or your exits. The most important factors of trading is literally, like I said, knowing about yourself, being well embedded in your own discipline, your own rules, and implementing your strategy. And it does take time. I mean, this is not something you can, learn in 1 year. I'm going to even say 1 year. You can kind of get a good approach on it in a year, but it does take a lot of experience because, going back to the many years of trading in my past, I think back, it's like, man, I've learned so much. Even last year with the whole, the coronavirus dump causing the market to go haywire, was a new experience. I literally had to challenge myself in a little bit different things. Last year was my best year ever, though, due to the extreme amount of up and downsides that we did have. But other than that, it teaches us good moments, and there's not a better place in the world than to have a job that you trade stocks for a living. I mean, there isn't. It's a great way to literally wake up every morning, turn your computer on, look at your watch list, prepare yourself for the day, and preparation. This is a huge key as far as being successful at knowing what you want for the day. Obviously, I do a watch list with our group every single Sunday night. And we cover all the sectors, all the different plays that really kind of drive attention to us as a group. Stuff that looks hot. And most people, or I should say some new traders, come to the market and they're struggling to find stocks. They want to find stocks and constantly sit there and look. It's all about finding the hottest stock, not necessarily finding the hottest stock. It's literally about understanding what sectors are getting attention, what sectors seem to glean for potential profitability. You don't want to just jump into something that's the hottest thing because more or less, you've missed the run or you've missed opportunity, and you gotta approach things early. Okay. Biggest factor I get that many people are asking is I literally keep a watch list of every sector of interest to me. Okay. I even got a beginner's options watch list. Okay. And I've got bank stocks, airlines, cruise lines, cybersecurity, defense, energy, EV stocks. You guys know that's been a hot sector late last year, early this year. Even food sector, healthcare, and even infrastructure is a sector itself. And I like to watch things. I like to take note of other people's analogy as well. And you got to keep a unbiased opinion when it comes to approaching markets, okay? You can't have a opinion and say, I think I'm bearish because there's such and such things that are happening. Inflation might be increasing. I don't like this. I think I'm going to go short. Price action is everything, guys. I learned that the hard way, that you can't pretty much play your opinion on the market when it comes to fundamental political aspects that play out. You can't do it. I mean, you can say that you don't like such and such things, but price action means everything. Just because we have an opinion on certain factors, I have to approach things in a different manner and be looking at the price action. And what I mean by the price action, TrendSpider makes an excellent platform that gives us their ability to, understand our price action, understand our strategies. And you guys see I have drawings on my charts. You guys can use their their automations and things of that nature that can be very helpful for new traders that want to use that. Me personally, I've gone to my own approach and given my own self, the drawing aspects, and I'm looking for certain levels, and I don't take a trade unless that level either breaks or held support or whatever it may be. There's certain things I'm looking before I take a trade, and I'll kind of break that down today. Amazon, for one, was an excellent trade this morning. I was all over the puts this morning, and most people are looking at this chart like, well, it's kind of bullish. We've been kind of consolidating up here, but no, I was dead set this morning. I was going to play some puts. I did play calls at the beginning because it's been a pretty frequent cycle that every single morning Amazon has a pretty decent push, a good 2 to 3 candle push. And that 2 to 3 candles, guys, when you're trading options, gives me a good $5 to $10 plus a contract. And trust me, that's a lot of money. Those options I played this morning, I think I jumped in at $23 a contract, which is $2,300 for one contract. I was flipping it at $28 and $30 a contract. So it was good money. I mean, you're turning $2,300 into $3,000 in just a couple seconds or a couple minutes, actually, and you're done with that trade. But it comes out with strategy. Obviously, the more contracts you get, the more it amplifies that move. But this is what I was doing. Obviously, you see the scenario here on a 2-minute candle. I was watching our support right here in this area right here based off of my support zones that I've drawn from the past of, daily support and so ons of the daily chart. And I'll go ahead and break down multiple time frames, but I saw the flush push down here. I grabbed in some calls. You're like, man, that's it. You're ridiculous to grab calls on a flush when things are already flushing out for the morning. I know this without fail. Amazon pushes up, man. All I needed was that 2-minute candle to make that jump from $23 to like 27, 28, and even close to 30 on the tip and top of that candle. Now, something you got to be important on this is have a candle counter. Most traders don't use a candle counter. You're like, what's a candle counter? Well, it's a very important aspect when you're trading stocks like Amazon, because even on a 2-minute chart, they gap up and gap down, okay? Even on a daily chart, you'll have gaps and gaps down, obviously from pre-market to after hours. But the weird thing about low volume or low liquidity or big name stocks like Amazon is there's a stretch of time that a trade doesn't take place because they're expensive shares. Take a look at this, okay? And this is let's see if I can pull it up. This is a red candle right here, meaning we opened at the top and closed at the bottom, okay? But we gapped down briefly right here before opening up, green to push back up to the upside. So in that sense, it was a gap from, what is that price? 33.64 to a gap of 33.62. So roughly a $2 gap there, okay? Literally no action happened when it jumped from one candle to the next, okay? All of a sudden that candle starts and it's a difference of $2, okay? Very important to watch level 2, which is your bid and ask price of Amazon, because those gaps happen and those gaps will actually influence the option before a trade actually takes place. Weirdest thing in the world, but I love it. So in that sense, I watched the flush come down, saw the gap down, saw the level 2 shot, was looking shy. That right there was just enough to make my options cheap before the candle started. Weird. But all I needed was 2 minutes to make that quick trade. And it's a scalp, okay? Obviously, these are not stuff that you want to just jump in and hold for long periods of time. But when I was waiting for puts, okay, this is another factor that 2-minute candles, if you're new to trading, guys, don't trade on a 2-minute candle. There's a lot of up and down noise right here that can really influence somebody in a massive emotional manner, I guess I want to say, because it's a lot of up and down. You're like, oh man, it's red. I better sell. I better panic, or whatever it may be. I was looking at the daily chart here, okay? And this is what's so important about the daily chart. And you guys can go back for weeklies or monthlies if you really want to swing trade some moves. But in this sense right here, I'm day trading, okay? In this market, that's all I've got to go off of. There is not enough potential out here to be swing trading because we have so much, I'm not going to say definite strength in the market or definite weakness. A lot of neutral ground is pretty much where we're at. I can't give myself to pretty much want to swing trade too much in this market, so I'm pretty much scalping moves. But this is an important factor right here. I was looking at 33.60 as my entry, okay? And as you see right here, I'm going to actually color code these so you can actually see them. But let's say we want to go to that 33.60. I'm going to right click on it. I'm going to change the color to orange. And you're going to see that 33.60. You're like, why would 33.60 be an entry for puts? Well, here's the reason of it. I'm breaking yesterday's low, okay? This shows me that the price action from yesterday can no longer retain this price. They're wanting to sell this out. This is getting weak. This is showing signs of weakness. I want to grab some puts on that. And of course, you have to know where your stops. You have to know where your exit or target strategies are at. And this happened so quick when it broke this 33.60. I had a target strategy to exit at 33.51, okay? Why did I choose 33.51? Because I had a low of day there and a low of day there. This is important to understand on these candles. And I had a low of day right here that I respected briefly, but it was only one spot. The more points of contact you have on a line, the more definite that line is going to stay true as far as being either a bounce, and that bounce can be the difference of you losing $2 a contract, $5 a contract, depending obviously on the option contracts you're playing. But very important aspect when it comes to that. So in this sense right here, I played the break of 33.60. There was no question about it. I was not going to take the put unless it broke 33.60. And people are like, well, let me enter right here and see if it breaks. Sure, you can by all means do that. But you got to realize there's really reasoning behind every trade I take. There's no just, I think Tesla needs to fall. I think Amazon just needs to crack and fall, and I'll just take a random trade. No, there has to be boundaries of why I take my calls and why I take my puts. And in this sense right there, I took this put literally on the break of that day based off of the daily chart. Now you see that's color coded. I'm going to color code my target here. Let's change it to like green or something. There we go. So there's my entry for 33.60, and my target was this 330, this 33.51. Okay. So in that sense, I'll go back to the 2-minute or 5-minute chart, and you're going to see why I took that trade. And it's going to bring some realization. Okay, well, there's my put. Okay. All it was one freaking candle. Okay. Look at this. We bounced right here. We broke. I've got my entry right there. That one candle right there made me a quick $3 to $5 move. Okay. On my contract. And that's enough to make 15 to 20% in just a blink. I mean, it's 2 minutes. Quick scalps. Okay. Obviously, we respected that 33.51. We bounced hard. We come all the way back up. And what do you know? I'm going to take a put if it breaks my target later, okay? There's reason I'm exiting at my target, okay? I'm going to see this bounce happen. Like I said, this is day trading. This is scalping. They're quick. And in that sense, we bounce, but there's a reason why you want to exit at that target, because without fail, on previous days' lows, we get constant bounces. They're happen. They're strong supports. We bounce, but this trade is not over with, okay? It's not done. Obviously, this could bounce, and I could lose all the money that I made on that one trade very quickly and even go quite a bit red as it went surpassed my original entry right here on this area here. And in that sense, we come all the way back down, and there's a new entry, breaking the target zone, okay? Then you got to start realizing, okay, what are next targets below that? So going back to the daily chart, you want to identify those previous day's lows, okay? So as I got right here, I can move this actually cross through here, and you guys can see why I call this what is it, 339 as a pretty prominent line, 338. Roughly in that range, okay? And you can be within a couple cents on a stocks or within a couple dollars on something like Amazon. So in that sense, we broke that 33.51. Next target was going to be 339, and you let it fall, and our next line is going to be this 33.28. It does alter some, some structure within that area as a very solid support. You've got an opening price there. You've got a closing price and an opening price. You have 3 points of contact showing that line is pretty definite. So we surpassed that line. I could actually throw some other lines. After this target of 33.28, I just got out of the trade. I was done for the day. Did not really expect us to fall as low as we did. We actually got a line about right here as well, showing we got an opening price. It's within a couple dollars or so of that closing price, that opening price, and also that opening price. So 33.11 is a pretty prominent number as well. So going back to the 2-minute chart, obviously it's going to clutter things a little bit, but at least you're going to get some parameters for where your potential stock may fall or go to, okay? So in that sense, broke entry right there, fell to some more zones and following and so on. And in this sense, this is more or less chop, okay? Midday, I'm out, guys. Pretty much around 11 o'clock or so, I'm done for the day. I mean, this is useless. 11:30. After 11:30, it was done with its dump. You guys can play this chop all you want, but this right here is where gains for the morning are completely destroyed, okay? If you buy calls and puts, and try to fight this as you're like, oh, well, it's reversing. Let me buy the dip. Oh, it double topped on the 2-minute here. Let's pull it back down. You got a double bottom right here. Oh, it's going back up, and you see this other resistance line. It can be a challenging fight, okay? And I don't sit here all day and trade all day. I'm pretty much done the first 2 hours of the day, and that's it. I make more than enough money during that period. There's been some cases when we have a strong market that I can pretty much take advantage of doing that. But it's very important to understand, learn to draw your parameters of a chart, learn to understand the structure of it. And in this sense, a couple weeks ago, we played the call side of this for a good week. Let's see, what was it? During the series towards the end of March, early April, I waited till it broke this 31.85 right here because this is a higher resistance, and I wanted it to kind of break out of this consolidation phase. I love consolidation phases. We broke through the consolidation phase, shot our way all the way up, and I also trade off of patterns, okay? I could zoom out, and you guys can see that I've got myself more or less a big symmetrical triangle here based off of previous lows, based off of previous highs, and you can let me get rid of these horizontals, and I can show it all. and you got yourself a very structured or, symmetrical pattern there as well. So I trade off these patterns because these trend lines do get respected. And it's very important to respect those lines as a pattern, somewhat as a pattern trader. I don't do everything based off of patterns, but it's all based off of the price action breaking previous highs, breaking previous lows, also attempting to break previous opens and closes, okay? Very important to know the opens and closes of your candles, also potential gap fills on your candles. And don't just look just at the daily, okay? I'll observe the weekly to see how we're looking. And on the weekly chart here, I see a very much of a consolidated phase. The monthly, this looks like a big bull flag, a very consolidated state as well. Very important to back things up, get a different perspective. And in some ways, I'll sometimes trade off the hourly chart too, and it gives me a little bit different perspective for breaking highs and lows on hourly charts for quick scalps, okay? And some of those trades can be 2 minutes, some of them can be 5 minutes. And if we got something that's trending like during this whole phase right here, man, this was like a cakewalk. I love something that is trending. But when we're in choppy waters or neutral or mellow markets like we are right now, it's choppy, guys. And most people can't trade that chop. And so that's why I'm only looking for those small scalps, okay? And those scalps on something like Amazon pay huge, okay? If you can read your chart and make sure you have them drawn very nicely. In that sense, I'll kind of cover another one here that's just did a consolidation break. I think that was Disney. I was waiting for Disney to show signs of a breakout of this consolidation one way or another. As you guys see, this right here is nothing but chop. You guys can trade that up and down, but you've identified many candles hitting a resistance and many candles hitting a support, causing this consolidation phase. That's why I highlight it, okay? There's no trade to be taken. You got to hold back. You got to hold some discipline, and that's a move between 190 and 185. And some people are like, man, I think there's good things to come in Disney. You can swing trade that. You can do whatever you want with it, but there's no entry for me, okay? There's literally no entry, and I'll just stand back and look at it and watch it. And I love the feature here on TrendSpider to where I have alerts I can set up and right-click on these lines and create those alerts. I can look away. I can look at something else and come back later if that alert buzzed me here on the bell. But in that sense, you see the break right here, 185.82. It finally broke, causing another awesome put today. Look at this. Broke those lines right here, broke the consolidation and fell. It fell literally all the way to my lowest support down here, causing a nice double bottom, okay? Now, what's to happen tomorrow could easily be a little bit of a bounce back because those buyers won't outweigh that, or the supply won't outweigh it for too long because you'll generally have a nice little flush come back sometimes. But if it is very detrimental, you will have some kind of continuation. It won't surprise me if this is actually even gap down maybe a little bit in after hours. Let's take a peek here real quick. No, it's pretty flat. It did fall down a little bit in after hours, but it's come back and it's fairly flat here in after hours. So with that being said, we'll see what happens tomorrow. It could be a nice little comeback to some degree, but it's very important to keep those charts analyzed. And I keep a constant watch. Like I said, this watch list gets updated every single week. Go through it all day Sunday. I mean, spend your entire day. Trading is not a 40-hour job. I mean, it's more like a 100-hour job, if you ask me. But you literally just got to dig in depth. Know what sectors are hot. Right now, obviously, I'm going to go to sectors that kind of interest me right now that I'm going to start getting interested in. It's obviously the EV sector has gotten beat down massively. I'm watching some of these like a hawk because they're getting to some crazy lows. I want to start seeing some potential for some possibilities for some long swings, long potential ads. Tesla right now, I still think is a little bit weak. Feel like she's going to actually fall down here to the lower lines here eventually, but time will tell. Obviously, it's got to break the price action from previous lows and highs for me to feel convinced about trading that to the downside. Obviously, trend is still up in our favor, and it's got a small downside here, but it's not much. Got to understand the trend story in order to know the potential direction of the price action of candles. Obviously, Workhorse is beat down to like crazy. Still watching that one. It's got even a small gap right there. So make sure you guys identify that little area right there. Small gap. It's a little lower than our current price action. So we may go fill it. We'll see. CBAT, I've got a few others in here. BDU is one that's been getting beat down a little bit as well. CHPT is one I'm really analyzing, okay? And CHPT is Charge Point Holdings, okay? This is a charging company, and I might add, it's the largest charging company in North America, the largest. Okay. These guys are so crazily beat down, but I can't have that biased opinion. Okay. I can't approach it and say, man, this is the best charging company in the world, I better start adding. No, I've got to let price action speak itself. And we're breaking levels I didn't expect to break. Okay. So very important to watch that. We're getting very close to 1955s, 18s, 16s. I'm really analyzing to know if we're going to actually peter down to those levels. Then I want to probably grab some January of next year leaps, $30, $40 calls or so on for next year. We'll see if that happens. It'll make a great swing play because you see the potential as far as move up in their favor, and we'll go from there. But I like that kind of play. I like these kind of setups that get oversold to some degree. There is no such thing as oversold. It just shows price action is, diminishing. The interest on the stock is diminishing. This was a SPAC play that turned into a merging acquisition and so on. And of course, when companies of interest kind of fade to the back burner, price action kind of fades to the downside. It's just the human nature. Obviously, there's stocks like Clove is one example of that. So many people got invested to the pumping story across the social media. So involved with these stock and like, man, this is going to go to $20, $50, $100, whatever price target you want to throw out there, guys. I can't come to you today and give you price targets like that because that's not realistic, guys. You can't have an opinion so enthralled with the fundamentals of what the company possibly can do. I'm not going to say that there's a possibility the stock could do that, but price action is going to tell me if it's going to or not. Another cool feature that I do use that some people look at me like, huh, what, you do what? Is I use fib lines in a very funky manner because it's the only tool I can use fib lines. And I'll show you guys here quickly. Let me see if I can find one that is at all-time highs. Home Depot's one, actually. And it's kind of to give myself an idea as far as what is potential all-time highs, okay? And you see these fib lines up here, okay? These are not actually fib lines. I'm using the tool as a fib line because it's the best tool I can work with as far as measuring candles. Yes, you heard me. Measuring candles, okay? Not many people measure or see the highs and lows dimensioning of their candles. And look at this. Home Depot's filled it to a T, okay? It's not 100% accurate, but it can sure get me a pretty dang good price target to know when I break a daily high or break a daily low to where it can go to and bounce to, because this is uncharted territory, okay? It's brand new highs. The stock's never reached that. And you're like, well, how can I predict how high the stock will go? Well, I use what I call measuring. Pretty much, I'll go ahead and show you guys, but I'm gonna go ahead and remove this. It's a 3-point Fibonacci tool. And in that sense, I'll pull it off from right here. And what I'm doing here, guys, is I'm measuring the dimensions on these candles to get a spacing for my lines. Obviously, a fib is drawn from the low and the high, but that's not what I'm doing, okay? Now, you see this spacing on this. I'm gonna change the colors on these real quick. Let me put it up here real quick, change the colors on it. Let's say we go orange, give us a little different perspective on it. I'm actually going to erase everything off Home Depot to give you a little bit better of a clean chart. So in that sense right here, I'm measuring these candles, okay? And you guys see the spacing. The higher I go up, the bigger the spacing on this fib tool gives me, okay? Like I said, I'm not measuring it from highs and lows to give a fib line. I'm literally using this to give myself a spacing of highs and lows on candles. So when I start seeing candles, because price action on charts are very similar. And with that being said, the price action on any particular chart is going to be based off of their share structure, how much is in the float, how much price action on a normal basis they get. And you can get a pretty good average of just measuring their candles to get a decent dimension for possibilities for their highs and lows. So right here, I've got a lot of candles hitting these spaces right there. So I'll click it. And now that I've got the space on my tool, I can raise the tool up as high as I want, maybe based on a series of candles like right there, double click it and leave it. So now I can kind of give myself a different perspective and make sure I draw some, horizontal support lines on past highs and lows through here that would cause me of interest. Obviously you don't want to chart, way back in history. You want to learn the very price action that you're dealing with as far as on a very close basis right here. Obviously, this was our opening today. This was our low today, so that's going to be important to know later on. So in that series right here, we couldn't get past the 327.93. We couldn't get past the 315.97 right here until later. So these spaces are important to me, okay? So as we break this 327.93, it might cause me interest to want to add an entry, okay? Obviously, that's going to be today's high of break as well. So entry on that break, I might be convinced that 331.62 could be a nice target for a quick play, even a day trade, whatever it may be. Obviously, this move with Home Depot has been insane, but this all comes back to the infrastructure stock, okay? We've got a president that's in office now, and they're talking about infrastructure, things of that nature that could be potential for markets. And I'm looking at it as an investment wise to look at stocks that would be of interest with infrastructure. Obviously, I keep a sector watch list of lows. Same exact thing of measuring these candles to give myself potential highs and lows for future reference. But I keep a infrastructure watch list and keep watch on some of these plays that keep me of interest for the potential setup. Anyway, guys, let's see. Anything else? Other than that, that's pretty much it. MU, as far as a losing situation sometimes on some candles. Let me see if I can find that real quick. MU here was kind of a fight as far as breaking 96.37 right here. Obviously, I was looking for entry. You know, break of previous highs. Look for entry for break right there. It broke briefly, but only like $1. Okay, so in that sense, this is a losing situation to where the play did not go to the following targets. Obviously, it's new highs. It's measuring candles. So in that sense, it didn't happen, didn't work. But with that being said, I have to stop out. Okay, if your entry's on break, I'm jumping out at break. Okay, my loss is going to be very minimal. Very important to stick by those discipline rules. Anyway, guys, I hope you guys have learned something from what I've kind of shared as far as what I'm looking for in the markets. Keep watch lists of different sectors. Stay focused on those sectors. Learn to draw your charts. Learn to know those highs and lows. And first of all, I really want to thank Trend Spider for having me on today. But hope you guys have a great week. Make sure to stay on top of your stuff and make some money.
Great stuff by Magic Mike, as always, really focusing on not getting married to a stock or a set of stocks. Next up is Jeremy Newsome, who I consider a good friend, as well as someone who really knows the markets and is a great trader. I just saw him in Miami at his recent event. He provided some great information there, and I'm sure he's about to provide some really great information on how he's navigated the markets over the last couple months. Let's hand it off to Jeremy.
All right. Thank you, Jake, for such a kind, amazing, and wonderful introduction. Friends and family, team and fans, followers from around the entire world. My name is Jeremy Alexander Newsome. And in this presentation, I'm going to do my absolute best to kind of just talk you through on how I like to at least do my absolute best to adapt to a changing market. Now, here is my take and my perspective on just the way the market works and the way cycles work. What we have to keep a cognizant realization of is there is only such a very rare thing as a very easy market. And what we were experiencing through a lot of July through really about February was an extremely easy market. There was tons and tons of very, very easy money to be made out there. So let's just go look at a few. For example, QuantumScape. This was one that everyone was talking about, was the darling of the world, couldn't go wrong until it did. And it went up, 800% from November to December. That's massive. Now, what you want to look for in a rotational market that we had, very similar to QuantumScape, is you're looking for these big, fast-moving companies to start to bust. And when you start to see those start to move, these leaders are the ones everyone's talking about, that's when you start really getting a little skeptical and you start to realize that you have to have a little bit of a different approach. So for example, there was another one, Workhorse, ticker symbol WKHS. This was another one that everyone and their mom was just all bullish on until about February 23rd. And this obviously happened in one day, this huge, huge move down, but it's cracks in huge stocks like this that have to give you a little bit of a warning sign. These warning signs and warning signals should be like, hey man, something is changing. These high pace, fast momentum stocks are slowing down. They're starting to crack, and you need to be really, really cautious. Number two is you need to make sure that you really understand the companies, because what a lot of people were doing was investing into companies like Workhorse and QuantumScape and Lordstown Motors, which is ticker symbol RIDE. No one knows what these three companies do realistically. So Lordstown Motor, Workhorse, and of course, QuantumScape, really not producing much tangible value, much tangible assets, and in general, realistically giving people a really, really kind of like sketchy, we don't know what to do, we're not entirely sure type of a fundamental approach. No one really knows what they do. They don't really produce a lot of value. They don't really produce a lot of content. And they don't really produce a lot of vehicles. An example, Arcimoto, ticker symbol FUV. Another similar example. Arcimoto, huge moves, absolutely gargantuan growth. Check this thing out. So Arcimoto grew from late October to February 531%. So what we have to keep in mind when something like that occurs is that is too good to be true. That is too good of a growth. So when you're talking about market rotation, one of the most important aspects is making money is easy, keeping it is challenging. So when you are trading effectively and you get a hot market where you get stocks that are just booming, they're doing amazing, like, oh my gosh, I doubled my account, I tripled my account. Those are drastically staggering figures that you have to keep in mind. Anytime you double or triple an account, that is just mind-boggling, especially if it happens in a short period of time. Now, of course, you can double an account in a year or 2 years, but if you're doubling an account in a month or 2 months, that is banana town. So from there, it's about risk protection. It's about cash flow protection and asset purchases when the market's doing really well for you. This is one of the biggest lessons I could possibly give you. And really, I'm talking to myself here because yes, I did take a very, very small haircut in February when the sector rotation just started happening. The market was really, really weird, but I only lost 10%. That's right, 10% of what I gained. So I did lose, and it was a lot. It was hundreds of thousands of dollars, but it was still an amount that was relatively small from what I actually gained. A lot of people lost all that they gained and then some because they were just so caught up in the hype. So what I would love to show you is, again, just looking at some charts, a little bit of the math behind how I try to figure and understand risk, but at the same time, how I can appropriate risk into a position. And we're going to do that with ThetaWarrior. Now, with every company that you trade, with any approach that you trade, it all comes down to risk, capital protection, and of course, cash flow. Cash is trash. Cash flow is king. So you want to make profits, but you want to keep those profits. You then want to take those profits and actually do something with them. For example, you could be donating, right? This shirt that I'm wearing, I'm repping the Leukemia and Lymphoma Society, the LLS. That's the charity that I'm going to be donating $100,000 to over the next 3.5 months. And I'm getting a lot of my traders and my friends and my philanthropists and my really giving, generous, loving traders out there an opportunity to help me with that goal. But that is an asset. That is a way that you can directly invest in yourself. So when we're looking at something like ThetaWarrior, for example, this move was a beautiful, beautiful move. Really good consolidation. I was asking a lot of my trading mentors and trading friends what they thought of ThetaWarrior back over here as I was pulling back into support. And one of their main questions was, I don't think that it's worth, $25 billion market cap. My answer was just simply, I know exactly how they make money. I'm quite confident they're going to go higher. You have so many people who are going to use them, who need them, who are intrigued about accessing and acquiring what is it they do. Teladoc is an industry in a sector that's never going to go away. People need telehealth. People need the ability to instantly contact their doctor. You guys understand how Teladoc works. So here's how I played it. On these down days over in this area, I was accumulating both shares and leaps. So number one, accumulation is a really, really interesting form of trading that a lot of people aren't used to. Accumulation is where you start purchasing small sizes over multiple days or weeks. What most people will initially do when they trade is they go, oh, okay, cool. I want to buy 1,000 shares. What day is it? Looks like it's 1,000 share day. And they just buy their 1,000 shares worth of stock. You can do that, but I generally don't suggest it, especially when the market or the trend is going against you. So I do have some indicators on here. I do use actual indicators every now and then. So I'll turn on some of my moving averages that I use. And what you'll notice is during this phase right here, the moving averages were actually battling the stock as a resistance. That's a huge takeaway because many traders, myself included in the past, would fight the trend, right? We would buy a bunch of shares, not knowing exactly what's going to happen with those amount of shares and expecting it to go higher. It's only when the stock is clearly above all the averages and the averages are acting as beautiful supports and you can see that it's evident. There's nothing in the way that's stopping it. That's when you can be more aggressive. That's when you can really buy with size, be in it, have tight stops and ride the wave. But when stocks break down their main moving averages with gnarly closes and ginormous heroic bearish volume, you don't want to buy a bunch immediately. You want to tiptoe in. This tiptoeing in accumulation process allows you to, number one, not freak out, but number two, get in slowly, dollar cost averaging in, and it helps you not worry about the bottom. It helps you not panic because your goal in this accumulation process is buy on down days. Right? Buy on down days. This will train you and teach you to buy lower. For example, if you're trying to buy a house, which I know a lot of us right now are probably looking at purchasing real estate somewhere in the US, you want to buy as low as you can, right? You make your money where you buy. So buy on down days. It trains you to do that. So when you're accumulating, generally you're accumulating when a stock is below its massive major moving averages. These moving averages that I'm using are the 100, 200, and the 105 EMA. So these are the longer term moving averages. And what you're noticing right now is, question, is Teladoc above or below its main moving averages? And the answer is it's below them. So am I accumulating Teladoc right now? The answer is yes. I'm purchasing it on down days, on weaker days. And by purchasing it, I literally am buying smaller size because this is how I protect my risk. You guys ready for this? When I get into a really nice trade, a really nice investment on a particular stock, whatever I make on that particular stock, that's my profit. I then allocate that profit on the second trade if I begin an accumulation approach, because there is a difference. You have accumulation and then you have trend trading. So I figured for a high degree of certainty that we're going to begin this accumulation strategy right about here. Again, when this huge candle after earnings came in and we closed below both the 100 and the 105 EMA, which you can see hadn't really happened except for this day right here. And when that did happen, I was like, okay, cool. Let me start accumulating, right? So I bought on this day, I bought on this day, I bought on that day at open because it was a down day. I thought this candle came in, looked really nice. I bought on that day. And then bang, when this candle came in, I was like, wow, we have a full on double bottom and we're back above the moving averages again. So when this candle came in, that's when I said, okay, I need to start imploring my accumulation strategy. So the accumulation strategy, again, buying on down days, but buying small size. If you have done the risk that you want to buy 100 shares of this particular stock, buy 10 shares a day on a down day, right? 10 shares a day. So that way, again, you're not panicking. You're not getting weirdly upset, but you're buying there, you're buying there, you're buying there. That's 30. You're buying there 40, buying there, that's 50, buying there 60, buying there 70, buying there 80, buying there 90, and buying there 100, right? If that's what your goal, if you're buying 100 shares. So you've waited, right? You were able to see a month and a half worth of data. And after you're seeing all that data, right, you're not really freaked out, scared, or worried as it starts consolidating. And then check this out. When the stock starts retrending again and getting back above its moving averages, that's when you can start going, okay, cool. I've piled into the stock. I've accumulated. Let me increase my stop losses on this position and or get in with some size. Now that I'm in the trade and it's beginning to work and now I know that it's working, let me get into this. Let me buy it and let me scale in with some more size now. Now that I've seen that the trade's working, now that I already have some, now that I've accumulated, now that I have some shares, let me get in. Now you can get in with call options, you can get in with shares, you can do whatever. But at that point, the stock was trending, right? It was above all of its moving averages and it made new highs. So this is another big, big takeaway. After the accumulation phase, sell into strength. One of the most common questions I get is, when do you know when to sell? And my answer is, when it's high, when I'm profitable. It's a terrible answer, I know, but it's a really, really effective answer, because you will always, write this down, my friends. If you're watching this, this is an extremely important takeaway. If you're here with us live, write this down. You will always sell lower than where the stock ends up going. You're never going to sell the high, ever, ever, ever. So it's okay to sell and lock in profit. In fact, the majority of my shares were sold on that day right there, right at 275. And then as it kind of came down, trailed back up, I just got out the rest over there and I was like, okay, cool. I'm now in some. Right now, here's where it gets really fun. Here's how I appropriate risk. Once I have a massive trade, this was a huge win, 6-figure win on Teladoc. Once I do that, right, I do my accumulation phase. I find a company that I know how they work. I've either used them or know people that use them. I know about their product. I've done some research. I understand their market dynamics. I get it, right? So it's not a Lordstown Motors. It's not a Workhorse. It's not an Arcimoto. It's not a QuantumScape. I actually know the product of the company. Once I can do that and I have a big win, and even if you did this strategy on those names, right, on QuantumScape, on Lordstown Motors, on Workhorse, if you did this accumulation strategy on those stocks when it was below this moving averages, here's the key takeaway. What I then do is I take my profits from that beautiful move, and those are what I reinvest into the stock, right? Just pure profits, not excess capital. So whatever I made on that trade, so let's say I made about $108,000, give or take, that's the amount of money that I'm going to reappropriate into this particular position. And then I'm doing it with following the exact same rules as before. So here's an example. We scroll in, right? Obviously, this was a really nice pullback on Teladoc. So yeah, buy some there. Why not? Right? Good pullback, could have easily gone higher. Didn't buy there because that's really the first day of selling. Right. This right here is the all-time high. It's never been higher. So I'm not gonna buy a bunch there at the all-time high after it's pulling back just a little bit. I'm not going to buy a lot here because it's the first day. It's the first day of selling. So the candle and the green arrow, that's where I started accumulating again. Okay, cool. Sorry, I apologize. Accumulating. That's why I bought some shares. I bought some shares as a swing trade on that day, expecting it to go lower. Now this candle comes in. Right? What's intriguing about this candle? Well, the intriguing part about this candle is it closes below the 105 and the 100 EMA. So what do? Again, I take my profits from the previous trade and I start allocating them out and realizing how many shares can I buy on 10 shares at a time on down days, right? So here's, this was the next day. So 10, 10, 10, 30, 40, 50, 60, 70, right? 80, this wasn't a down day. This was a down day right here, 90, 100. So having that cost basis right now on Teladoc, you can see that I'm flat, not really up, not really down, but I was able to leg in. I had a decent leverage. I'm using my profits on the particular trade, on the previous trade, right now, only at about a $20,000 investment on Teladoc, which if I made $108,000 on the run up, I still have about $80,000 to spend. So the question that you're going to ask is, when do I start spending that money? And the answer is, at least for me, when we start getting back above these moving averages. At this point, I've accumulated, I'm in. Earnings on Teladoc is right around the corner. So when earnings come out, what I'm going to do is look over the report, see how they're doing. I'm assuming Teladoc is probably going to gap up into here and fade down on earnings. That's what makes the most sense to me. Again, anything is possible, but that's what I'm assuming happens. Now, let's say they have an okay earnings, they gap down and just kind of keep chilling. Then I'm going to keep chilling. And right now, my stop loss is intact on Teladoc. But remember, right now, I'm investing my profits. So here's a weekly chart. Now, a weekly chart, I'm still keeping a very close eye on. This is my other position to buy the rest of my $80,000 worth of Teladoc is around these long-term averages. If it pulls back into here, that's where I'm gonna start buying more. That'll be my final position. That'll be my final size. I'm like, okay, cool. I'm in this to win this. However, if that doesn't happen, right, and we go back to the daily chart and we reclaim these long-term moving averages, just like we did over here, then that's where I will start adding more size. I'll start buying call options. I'll start buying shares. I'll be able to do that with the profits that I made from over here. Okay. So that's the main way that I do this. That's the main way that I'll approach it, is when I'm trading these stocks, I'm trading these companies. If we go back over to the ones I mentioned at the very, very beginning, QuantumScape as an example, huge, maniacally massive run up. This was one of the very first ones to pop. All right, one of the very, very first ones pop. So when you're dealing with an 800% return, and full disclosure, I didn't make any money on the write up on this at all. But if I did, I probably would have bought somewhere over here, most likely. And following the rules that I just mentioned to you earlier, sell when you're profitable, sell when it's high, sell when it makes a new high. I would have sold somewhere over here, right? The majority of my position, it came back down. I waited and I would have sold the rest right there. Very similar pattern to Teladoc. You can actually see it. Extremely common, right? Trade sideways, hung out, made a new high on a gap, retested, and pulled back in. So I'll show you. We'll go back to Teladoc and I'll show you. That's the exact same pattern. These patterns happen all the time, everywhere. It's just pattern recognition. That's all trading is. Pattern recognition, math, and keeping your profits. So same exact pattern. Look at that. All I'm doing is just drawing. I just moved it from one chart to another. So you can see it rotated down, big pop, really nice profit, pulled back down, made a new high. So that's when I sell. I sell at new highs. I lock in profit, and then I take the money that I made from that and I do something with it. Normally it's donating it or buying an asset. That asset could be cryptocurrencies. That asset could be real estate. That asset could be businesses. That asset could be business coaching advice. It could be anything. It's some asset, some type of investment into myself. It can be books. It can be a physical trainer. It can be a class, a course, a session, something. So I'm taking the profits that I'm making from things and reinvesting it directly into myself, into my mind, into my business, into my trading business. That's what most traders, unfortunately, do not do correctly, is they simply do not pull out profits at all, because they're like, I want to keep growing my money. Bro, everyone wants to grow their money, right? You're not special. The way you grow your money is by taking it and buying assets that accumulate over time. And again, those assets can be other shares or other companies of stocks that are going to grow over time. Right? So that's the exact same pattern on Teladoc. Now let's go look at the other one I mentioned. I picked on Workhorse, right? So if we go look at Workhorse, you'll notice same pattern that I drew. It's a little different, but it's very similar, right? So this is the exact same pattern that I've drawn on the screen. I haven't changed anything except the stock. So you'll notice right here, you're above the moving averages. So when you're above the moving averages, that's a strong play. That's one of the trades that you can be more aggressive on. You can be more directional on. You can be more active on. But here's the position that I probably would have bought somewhere over here on some pullbacks. You get the gap up, bang, take some profits. You get the pullback, bang, take the rest of the profits. Buy low, sell high. And the interesting part, the really weird part that I'm just now noticing, and I'm serious when I say this, I'm just now noticing that this is actually an Elliott wave count. The thing I have drawn on the screen. So you have a 1, 2, 3, 4, 5. But ironically enough, it is that simple. This is an Elliott wave structure. I was like, oh, okay, it makes perfect sense. So this Elliott wave structure is how I play things, right? I try to buy onto a pullback. I sell it when it makes a new high. I hold through the retracement. When it makes a new high again, I sell. I lock in profits and I take those profits and then I go buy things, those assets, other stocks, other companies, right? I take the profits and I reinvest the profits onto those particular companies. And if the stock breaks below its long-term averages and closes like this, then I accumulate only on down days, usually in 10 to 20 share increments, unless it's a cheaper stock like this, in which case I'll do like 100 share increments. But in general, I need to make sure I know what the company does. I know how they make money so that I can be more confident in really taking a position in them. One of my largest positions right now is Upwork, UPWK. So Upwork, you'll notice, has not gotten below its moving averages. So what I'm doing right now is I'm still actively trading this one. I'm still directionally trading this one. I'm buying it with some size. I'm holding on to it and I'm selling it when it's higher. So if you're wondering, if you're asking yourself, when am I going to sell Upwork? The answer is very easy. When it trades back up into here, right? Does one of these, has a pullback, boom, I'll sell, bang, and boom, I'll sell the rest. And then if it pulls back into the moving averages again, I'll go long. And if it closes below the moving averages, I'll start accumulating shares on down days until it calms down, chills, and then eventually pops higher above its long-term averages. It's that process over and over and over. So the sector rotations are going to happen in all stocks for the rest of eternity, in all sectors, in all industries. This was Peloton. Very, very popular stock. Everyone and their mom loves Peloton. I like Peloton. I don't personally have any positions on Peloton right now, but I like Peloton a lot. When this candle came in, notice how well it's closing below all the moving averages. And obviously, I know it seems and looks really, really easy right now, but here is again that pattern. Boom, 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 boom. Same exact pattern. Wave count, baby. Elliott wave is serioso. All right. So again, would I have sold right there? No. No, I would have sold probably some over here, right? Locking in some gains. It trades up, it has this little pullback, and then bang, lock in the rest of the profits over here somewhere. And then again, take the profits that you made from that trade and reinvest them, right? Take some swing trades. That's fine. Wait for it to come down to an average. So probably buy some there, take a breakout right there. I did. I took the breakout on this candle right there. Took the breakout on that candle, and then boom, got stopped out right there. So I took my loss, right? So I took the profits I made from that trade, reinvested into that position, and bang, immediately got stopped out. So I'm losing. Okay. So when this candle came in, it was below its long-term averages. I was like, oh, shoot, I got to bail. I'm going to go wait on Peloton. I took some profits on it when it was in a nice uptrend, when everything was looking good, when everything was working, phenomenal, awesome. And so now I went out and bought a road bike. I bought that road bike to start practicing for some triathlons, but that's an asset to me. Taking the money that I made from a bike company and buying a bike makes perfect sense to me. So for right now, if you wanted to get into Peloton, you'll notice it's below its long-term averages. Therefore, it's consolidating. Therefore, it's in an accumulation phase. And again, therefore, you wouldn't want to actively trade that. You would want to most likely accumulate on down days. So obviously, yeah, there's tons of examples here on down days, and it's $100 stocks. So you're probably buying 10 or 20 shares at a time. Again, all this depends on your account size. All this depends on your risk tolerance. There's a lot of factors that goes into how many shares that you're buying. When I do directional swing trades, it's very, very easy math. It's extremely, extremely simple. The math formula goes as follows. You have a risk, whatever your risk is, right, divided by the entry, all right, whatever your entry is, minus your stop loss. Okay. So that is the risk formula. So normally for a lot of traders, it looks something like this: $2,000, which is normally, a percent of their account. So let's say 1% of your account is $2,000. Then you divide your trade. So if your entry is 102, right, and your stop loss is 100 on Peloton or whatever other stock, that would be your risk, right? 2,000. The difference between these two numbers is $2. So 2,000 divided by 2,000 shares. Okay, so if you buy 1,000 shares here at Peloton and it breaks down, it goes down to 100 and stops you out, you lose $1,000. If it pops and breaks above and trades back up into 120, you can make some serious money on that particular trade. You can make some gorgeous, gorgeous R's. So that's the risk formula for just general active directional trades. What we're kind of describing right now is positional trading, because in positional trading, you are going to have those sector rotations. And for me, I need to make sure I am trading companies that I know, I understand, I like, I enjoy. I'm very comfortable with how they make money. I use their products. Companies like Johnson & Johnson, yeah, super boring, but dang, look at how beautiful this thing pulled down to those long-term moving averages and bounced. So good. This was like a one-day accumulation because you had the one day right here where it closed below both moving averages. The very next day, okay, I guess it's not. Awesome. All the bears are trapped. Let's go directional. Boom. Take a directional trade, stop loss. Bang. Gorgeous trade. Pulls back to the 100 again. Buy it. Oh, gorgeous. Ooh, right to that high again. Sell it. Why not? You sold it there earlier, it made a profit. Sell it there again, lock in a gain. And it doesn't matter what type of profit you're making on this trade. Let's say this whole trade right here is $100 profit. There's a lot that you can do with $100. There's a lot of books that you can buy. There's a lot of courses that you can take. There's a lot of education out there that's available for $100 that most likely could change your life. Invest in yourself. Understand that in order to become a better professional, profitable, consistently profitable trader, you need to become a better person. Okay, you need to grow an epic beard. I'm just kidding. You don't have to have a beard, but you do have to spend a lot of time being disciplined, being consistent, and being extremely, extremely focused on your craft. This is a business. Come up with a plan, come up with a strategy, and practice this stuff. If you want to practice with me for 7 hours, you can hop over to my website, reallifetraining.com. This is an entirely free program. You're welcome to donate to the Leukemia and Lymphoma Society if you would like to, but it's a free program called the Back Trading Marathon. This is where I went for 7 hours and I just practiced exactly what we're doing now for 7 hours straight, no breaks, 8 a.m. to 3 p.m. Central. So it is free. If you want to pop over to my website, reallifetraining.com, click on it. And again, if you would like to make any type of donation to the Leukemia Lymphoma Society, we're going for $100,000 for the next 3 months so far. $15,000 already there, 15% of the way to our goal. My friends and family, team and fans, followers from around the world, thank you so much for tuning in. It means the world to me. If you are a big fan of podcasts, go to broketowoke.com. Even your boy Jake from Trend Spider likes this. This is my new podcast with myself and my business partner and one of my best friends who's actually coming to my house tonight. Her name is Brittany Turner. She's amazing. Make sure to check out this podcast. It's obviously free. It's entertaining. It's joyous. It's fulfilling. And there's a lot of really great nuggets of wisdom that are located in that podcast. So my friends, thank you so much for watching. You are incredible. And until next time, remember, love life, live life, and trade it. You rock. Goodbye.
Great presentation by Jeremy Newsome, as always. I'm not sure what was more impressive, the presentation or this guy's beard. It is absolutely huge. And going into the next presentation, we have Market Traders TV going over a little bit about how they've navigated the markets and how they plan on navigating moving forward. Let's jump right into it.
All right. Thanks, Jake. So I am Mike from Market Traders TV. With me is my partner, Tempos. And today we're going to talk about some basic risk management and trading uncertain markets and applying rules and plans and things about how you can be better in your trading by having a community behind you. So one of the first things I want to talk about is the idea of risk management. And I teach this on my stream on Twitch. To everyone, basically the same ideas. And what I like to teach is when you get into a trade, you want to apply 1% total capital loss to that trade idea. Now that can fluctuate between 0.5 and 2%, but we want to have an average around 1% total capital loss. And what that means is when you find a level of support that you want to buy in a trending and an uptrending market, that you don't risk 1% as in a 1% drawdown. Your risk is based on where your trade is invalidated. So that would be the next swing low or whatever you decide. If I want to get long on the, let's say the SPY or whatever, I want to get long here. And if price achieves or breaks a specific spot, I no longer want to be in that trade. And the 1% rule applies from your entry to your stop loss. So your stop loss could be potentially 5% away, 2% away, whatever, it doesn't matter. But as long as from your entry to your stop, you're not risking more than 1% of trade. That's a very, very key thing. And that allows you to be in many, many trades at the same time, spreading your capital around different equities. If you're a futures trader, whatever, trading different futures contracts. But that's a very, very big rule that I teach to our community that we have. And a lot of people are really successful about it. And new people come in sometimes, they ask, well, 1% sounds pretty small. And the answer is to that question, 1% isn't small if you're risking 1% to make at least 3% around your first profit target. So it'd be a 3R trade, as they say. And I also advocate having more than one profit target. I advocate having at least 3 up to 10. But that's a big thing about risk. If you're risking 1 to make 3 and your strike rate's above 50%, you're going to be generally a profitable trader. And 3R to your first PT, right? Having multiple PTs. So that's my main thing about risk management. And that goes for any type of market. Doesn't matter if you're with trend, if you're counter trend, doesn't matter. Now, the next part into that is about trend. If you're taking a counter trend trade, risking 1%, I advise people to move their stop loss up to around break even after their first profit target. Now, this is a counter trend trade. So if the market's going up and you take a short, risking 1%, after your first short profit target, having at least 3 profit targets per trade, you should move your stop to break even after the first. Now, conversely, if you're trading with trend, same idea, risking 1% to make 3 on the first profit target, you can wait to move your stop loss until around your second profit target, or at least getting close to it. So 2 different ways of trading. Counter trend, first profit target you take, move stop to break even, risking 1%. With trend, move stop loss to break even after second profit target, still risking 1%. You want to always have that type of plan, no matter the market condition. If you stick to that plan and you never deviate, you never go, well, this is, a really good trending market. I really like it. This is great stuff. I'm going to risk 5% of my account. That's a recipe for disaster. Now you might look back on it and go, well, if I did risk 5% there, that would have been an amazing trade. Instead of making $1,000, I would make $14,000 or something. But you don't want to do that. You always want to stick to that plan, no matter the market conditions. And if you do that over time and your strike rate is good enough for a 3R percentage, you're going to make money and you're going to be happy in the market. So I really do think that's one of the biggest things that people fail on is they get emotional. They hit a lot of stop losses or something, and then they try to do a revenge trade. They're like, okay, I got stopped out 3 times today. I lost 1% each time. So I'm going to try to get that back, and I'm going to risk 4% on this next trade. And that just compounds the losses. Instead of losing 4% on the day, they lost 7% on the day or whatever. And that's going to happen. But sticking to the plan and only risking 1% or even less, a lot of times I'll take 0.5% trades and be perfectly happy with them, is a great way of going about trading any market cycle, in my opinion. So also, when we talk about trading different market conditions and trading in like an uptrending market that's going into a sideways market, accumulation distribution, whatever you want to call it, into a downtrending market, one of the best things to do is to not be by yourself, to not be stuck just alone in your basement trading by yourself. And that's another thing I focus on our Twitch stream. It's, by the way, it's Twitch TV, Market Traders TV. If you want to see us live, we're live every day, 7 days a week. We focus on community. And the biggest thing about community is there's more eyeballs on more things. So say, for example, the SPY is trending up. Obviously, it's near all-time highs right now. The SPY is trending up. There's a lot of companies in the S&P 500 that aren't looking exactly like the SPY, and there's opportunity there. But you don't want to be going through 500 charts a day by yourself. And that's where community comes into play. Having hundreds of people behind you, hundreds of people supporting you, everyone working together, saying, okay, here's an idea. Like, look at this ticker. This ticker's at a good spot of support or resistance right now. It really does help navigate any sort of trending market, up, down, sideways, whatever. And it's one of the main things we focus on the stream is building out, because trading doesn't need to be a solo activity. And a lot of people treat it as such. A lot of people, they think that they have their own special secret sauce and they need to hide it from other people. No one can know, my golden goose, even though that doesn't exist. And it's completely not true, because the market doesn't care. The market's going to do what the market's going to do. Your ability to make wealth is your ability to capitalize on these moves. And the more people, smart people together, looking at them together, the more money you're collectively going to make. That's kind of where I wanted to leave it off with risk management and community. If you wanted to go into another talk about trends and such tempos.
I want to address the verbiage uncertain markets for a quick second. I think that when you understand trend, there's really no misconception of what's going on in a market. You really only have three, I call them climates. So you really only have three market climates, right? You have, you have downtrending, you have uptrending, and in between you have these little sideways things, right? Chop, consolidation, whatever verbiage you want to use for it. No matter how you look at it, the market's doing one of three things at all times. I think the misconception comes into play when the misunderstanding of trend becomes over trading or decision paralysis. There's a lot of emotional and psychological responses people have when they lose the higher time frame trend, and that generally comes from, in my experience, when I see people zooming in too far, misreading what's going on in the higher time frames and trying to really maximize what's going on in the lower time frames. There's absolutely nothing wrong with these lower time frame trades, but you absolutely have to understand what type of trader you are and how you respond to different situations in markets. I've met a lot of long-term traders or people that like to buy stocks and hold, try to step into the scalping world, or try and step into the low time frame leverage trading, margin trading world and completely blow out accounts. I see people that make tons of money, on this massive push up and then give it all away in a short period of time, where they buy the dip, and for some reason they lose confidence, or they take a big downswing with bad risk management, or they just, they didn't really understand what this sideways action was implying. Does the trend continue, or do we lose the upward momentum and start a downtrend here? And more often than not, when these newer traders come in, or even experienced traders who get the zoomies and lose the concept of higher time frame trend, they give back everything they made in this easy mode. I want to call it the hyper trend, right? So as far as risk management goes, I think the key to it is having a proper strategy, knowing how you will respond psychologically and what you will do in every situation. Some of the best trades I take, and this is going to kind of sound cliche and maybe not direct to the point, but some of the best trades I take are not taking trades at all. It's seeing my setup, happening in a few hours or a few days and waiting for that to happen. And the more the more inexperienced me, if I would go back, a year ago, 2 years ago, 3 years ago, even 6 months ago, because I'm continually learning. I'm trying to hone my craft. There's, on my off days, I'm doing paper trading still. I believe in practice. And, I've been preparing for many years, but there's no champion out there in any sport who doesn't put time in the gym and shoot free throws to win that championship. So I still practice, right? If I don't hone my craft and work on my strategy and make sure I'm mentally prepared for every type of situation in a market, then I'm going to fail. I'm going to lose that that psychological approach. And as sound as my strategy is, I might fall into that, what's going on moment, or that uncertain market feeling. And I'd like to avoid that as much as possible. So back to the original point of risk management, I think that if you don't have the proper strategy, no matter what you tell yourself, whether it's 1%, 2%, 3%, that goes straight out the window, as Mike said earlier. When you're starting to see your P&L go down, your UPL is dripping, all the money I made the past couple of months is going away. This was easy. What's going on now? And you start reaching, you start blaming, news outlets, you start blaming companies, you start blaming yourself, and you point a lot of fingers in different directions. And that's that spiral that turns into revenge trading and, excessive losses. And it's important to have that mental check in play and know when it's time to wait for a trade or step out of a trade, or when to step away from markets in general. So a systematic approach and discipline and practice will get you to where you want to be. It's important that the strategy you have is universal and can survive the seasons or climates in the market, I believe. My strategy works up, down, left, right, whole day start. It's not the cheat code, but no matter what's going on in the market, I wait for my setups. I have 2 or 3 setups, and that's it, that I play over and over again. And I believe in simplicity. The easier it is to execute on a mechanical level, your strategy, the less mistakes you are likely to make. If your strategy only consists of a couple different things you're looking for in a market, then there's really no room for misinterpretation. There's really no room to blunder on a mechanical level, right? Click the button at this time, entry here, exit here, profit here. It's all about your approach on a mental scale at that point. So again, minimalizing potential human error is a key factor to risk management. And people like to talk about R and percentages and, what's the next big thing and waiting for earnings calls and all these extra things they add on. and I believe in simplicity. So, someone could say, hey, Tempos, we're trending up for months and months and months here, right? No one could have seen this coming. And sure, there's people out there that, this is obviously the Corona dump here, right? Sure, there's people out there that, got out at the top or maybe got out a little bit early. When it comes to a major market shift, and you're not going to see these events happen this dramatically. It's like a 4-week period where we dump down a massive amount, right, across every single market everywhere. You're not going to see these massive events happen too frequently, but when they do, they could be traumatic or devastating for people. And, it sucks to be caught, pants down, UPL completely decimated and, potentially recouping from absolutely nothing, or maybe you decide to quit forever. The key factor to this is, as Mike said earlier, taking profits. He likes to have a set amount, whatever it was, the 1 or 3 for the short term and maybe 10 profits to keep on going. My approach is a little bit different depending on what I'm trading, if it's a stock or an option or something leveraged, margin futures, whatever, Forex, crypto. If we're in a massively trending market, and I'm like a super trend, I'll call it, or hyper trend, I'm similar in the fact where I'll take profits as we go. And if we're in price exploration, it's, it's a fib pull, take profits at potential failure fibs, 1618, 272. I delete all the in-betweens. These are my main numbers on fib, 618, 272. And I'll take profits on the higher time frame pulls going up. And you can see this one came pretty close to, if I could get that exact, pretty close to that 618 and fail right there, right? Not to say you could have called the top, but if you were taking profits accordingly, let's say you got in on a support gain or whatever entry you have here, you would have had a couple profit targets along the way to get there, and you would have been fine, right? And you could maybe throw in the method of dragging the stop after you gain a higher level support, a weekly or daily, and continue to buffer for that massive UPL drawdown. But if we want to negate and not really look at these massive, disasters in the market and talk about regular trending markets here, right, where you're just kind of stair-stepping up the entire way, the method I would use is, same thing, proper stops, proper entries. Let's go ahead and get rid of this real quick. Get rid of the rectangle. Let's get rid of the fib. And let's say we got in somewhere in here, right? Proper support level. Oops, let's drag that back. Come on, little guy. Proper support level. Price expiration. So we're going to pull a fib. We'll pull it from the body since there's not much going on there. And we're taking profits, right? So we're taking profits on the way up, 618, 272. I like to rotate my profits into different places. I hate the cliche term diversify, but especially if I'm trading something like NQ or ES and, I'm on leverage, I like to move those profits around, throw them into stocks getting towards support, crypto getting towards support. I think it's important to always have your profits working for you. And for me, one of the ways I mitigate trend shifting in a market is to be in different markets across the board and make sure I keep rotating my profit around. That way I don't become too heavy in one area, one market, and I have protection in that way. It's really my best case scenario, right? Keep on rotating profit and using them in different markets.
Absolutely. So do you want to go over a recent idea that you may have had?
Sure. Go over Bitcoin. This one today. All right, so we took the short on Bitcoin here at the weekly. Let's drag it down a little bit. Keep it in play. Let's zoom in a little bit to make it interesting. All right, so zoom in a little bit more so we can see what's really going on. Actually, that's kind of off there, isn't it? There we go. Beautiful. All right, so this is a pretty good example to me of sticking with your guns and not chasing a trade. So let's say you had this weekly marked off and you didn't fine tune the idea, right? We zoomed into an hourly just to show you what potentially could have happened. And I see this happen very frequently with traders where they set up their idea and they were, whatever verbiage you want to use, they were front run, they missed it by a tick, missed it by a point. They don't really take into consideration the time frame they're trying to trade, right? They zoom in a little bit too far They think, I missed my opportunity, whatever it is, this always happens to me. Why do I always miss my trade? This is going to be the big one. And they end up doing something crazy like market smashing in, right? This candle or maybe this candle, whatever. Instead of sticking to their strategy, having the patience they should, right? Letting price actually do what it would do if you follow price action accordingly and getting them back up and actually taking their trade appropriately. When it comes to things like Bitcoin, I like to layer in a little bit. I don't believe in a single entry. I like to put in, short here, obviously, short here, and get the best average possible. Obviously, with a proper stop above levels to the left there. We're not going to get into the setup, but more importantly, I think it's for this particular trade, it's always a good lesson to not to chase what you think you missed because your opportunity might not have arrived yet. And when you start to chase ideas you think you failed on, you might be missing out on the right opportunity coming up to play.
Yeah, it's a big thing about mentality. Patience as a trader is one of the most important things. And one of the things I like to tell people, especially new people, is when you have a trade that you set up, like I like this idea. I'm going to take this idea. I've established my profit. I've established my stop. I've established my risk, all my profit targets. I like to say, just go on to the next. Go look at the next chart. It's another big thing about community too, because there's always more things to look at. So how do you go about that when you're, like, say, trading futures and things?
Well, with futures, I like to wait until I'm in a trade. I don't like to walk away from that much leverage and FX. And if I'm doing leverage crypto trades, I have my set trade in, entry, stop, and profit prior to price making its move to the direction I want to. But there's a lot of methods you can do. I listen to a lot of stories on people who, turn their computer off or walk away from their computer that trade better in their sleep than, when they're awake, because they fiddle with everything they're doing. They like to move their entries and stops around. And the most important thing you can do, not to be cliche again, is to journal and record those particular moments when, let's say I had an entry at 418 here on SPY, or we'll say 418.50, right? Just for the sake of argument. So let's say you were trying to get in 418.50 for whatever reason, and you missed your trade, right? Then you get emotional. You're like, man, this happened to me again, yada, yada. And you spike back in, right? You decide to market smash here. You think you're a genius, and all of a sudden price comes back up and smacks through you and you get stopped out. And for the sake of argument, let's say price continued down, right? After that, there's no way to have a perfect memory. And if you try and tell yourself, in the past I've done this before and it's worked out, or in the past I've done this before and it hasn't worked out, you're going to end up lying to yourself. And there's something permanent about black and white text on a computer, or pencil on a pad or ink on a pad, that it gives you that certainty factor of, this is what I did last time, and that's how you build from it. If you can't learn from your mistakes and your successes as well, right? Maybe you were successful by not market smashing, or you were successful by waiting for it. Maybe you write down, hey, I walked away last time from this trade, had the entry set and stop in PT. And when I walked away, that was my most successful trade I've had this week. And, you try and imitate what you do right, and you try and get rid of the things you do wrong. I found one of the biggest hurdles for me when I started to really turn that corner was I had my set strategy in play. I knew what I was doing, and I started focusing on the things that I was doing that was really clipping away at my P&L. The times where maybe I layered too many times, too many entries in a trade, or maybe I took too many profits too early. And I started looking through my journal and trying to maximize situations I was in. Instead of saying, okay, I got to be in every trade, I started saying to myself, okay, how do I maximize every trade? And it was just me basically going through line by line, figuring out what, situations where I was diluting potential profits. I could have gained 5% here or 10% more here, and just eliminating those errors from my game. So reflection is key. No matter what coach or mentor you have out there, it's important to be your own coach and mentor. And the best way to do it is write it down.
Yeah, that's great advice. Was there another example you wanted to go over, or can we?
No, we can move on from that.
All right. So I want to circle back again on community for everybody here. So we are a trading community that is 24/7, 7 days a week. There's always someone live on stream, but the community is always live on Twitch. Once again, it's Twitch TV/Market Traders TV. It's there 24/7, and our focus is really truly on everyone's success. We teach every day, new traders, old traders, everything in between, how to be successful in the market. And our results, we could do a little brag session, but some of the results have been so unbelievably, honestly unbelievable, that we've grown this community into a lot of really trusted individuals that are truly making wealth. Not just making a paycheck, they're actually changing their lives. And we implore everyone to come check us out, be a part of the community, and we're here to help. Our motto is, trade the markets, make money, and be happy. And we're literally just here to help you guys. And the more the better. The more eyes, the more smart people, the more trades that we can take ourselves. If we have 1,000 eyeballs looking at the Russell 2000, right, there's going to be opportunity there every day. And that's basically it for us, though. Just check us out, Twitch TV, Market Traders TV. If you have any closing thoughts, Tempos.
Yeah, when you're a newer trader or a struggling trader, I think you try and latch on to whatever's out there, influencers on Twitter and, whatever, maybe signal groups, or you try and do crazy things, right? When you're emotional and desperate, you latch on to whatever seems like an opportunity, to make that quick buck or to fix whatever problem it is. And it usually doesn't work out, not to be a bummer on that. It's what you need to do. What I did and what I suggest you do is you find a place that you're comfortable, that you can have open discussions, people that will challenge your ideas and not just, echo chamber you. That's why I love the community I'm a part of. There's a lot of people out there smarter than me, and, people out there that reach out for opinions and, charting questions to me, and just through common conversations I have with them, I find myself looking at things a little bit better and a little bit differently. You never know what you're missing if you don't employ yourself and prop yourself up to that level. Even if you think that you're inexperienced, there's always something to teach somebody else. And obviously there's something to be learned if you're in the right place. Just be careful out there. There's a lot of things going on in these markets, and, influencers out there that really don't have your best interest in mind. That's why I'm proud of my community, because everyone out there really looks out for each other.
Absolutely. Once again, check us out on Twitch, Market Traders TV. We also have a YouTube channel, same name, Market Traders TV. And thanks so much for the TrendSpider guys for having us on.
Yeah, thank you.
Great stuff by Mike and Tempos from Market Traders TV, really focusing on the community aspect and having multiple eyes on the market so everybody has an idea of what's going on rather than just being in a vacuum. Next up is Jack, aka Alpha Trends 365 on Twitter, going to talk about how he's navigated the markets over the last couple months.
All right, thanks, Jake. So I'm Jack from Alpha Charts on Twitter, Alpha Charts 365, and today I'm going to talk to you about how I set up my charts, some trades I've been in recently, and what I'm looking for going forward on the macro side of things. All right, so first off, how I set up my charts. I'm going to use Futu, F-U-T-U, as my example here. And actually, you know what? Just take care of that. All right, so my basic chart before I do anything to it is going to have a few elements. I'm going to have, first, obviously, price. I use Japanese candlesticks, hollow candlesticks. And if you go to the TrendSpider blog, they have a good example of what the candlesticks actually represent. So you get, 4 pieces of information, right? So you get the open and you get the close, right? Open and close. You get also the high and the low for the day. But then you get another piece of information, which is actually really important. So you get basically the sentiment for the day, or who's in control, really. Are the sellers in control, or were the buyers in control? So if you have a filled in body, the open was higher than the close and it's filled in, that the sellers were in control at that point. Now, if you have a nice clear body, that the buyers were in control. So in something like this, it opened low, maybe went a little bit lower in the first 15 or 20 minutes, and then the buyer stepped in and went up and then came back a little bit before the close. that's a nice looking candle, even though it's a red candle. It's a nice clear body. It's a good candle, and buyers again stepped in where this is a very ugly looking candle, and this candle, which is still green, but again, it's definitely one that I would question. So wanted to explain what the candlesticks were and what they represent to me. Now, the other thing I have on here is going to be, I use one moving average, which is the 23-day EMA. And, you know, a lot of people ask me, well, why the 23? And so there's a couple of really good reasons for the 23-day EMA. First off, it's about one trading month, right? There's about 23 trading days in the month. So it's one calendar month, I should say. There's about 23 trading days in the month. So that's, I think that's important. The second thing is most people are using the 20-day or the 21-day. It separates you a little bit from the pack. And I like that. I don't want to be all bunched up with everybody else, because that's where a lot of people may put stops or something like that. So again, it gives me just a little bit more room. And the last thing is that it's I forgot the last reason right now. So we're gonna keep going. But one of the other things I use is I like using the Ripster EMA cloud, and I like to go with the shorter time frame sometimes and a longer time frame, and it creates a nice cloud if I want to get the essence of what the trend is. And so this is kind of a nice little thing that I like to do, and it kind of helps me define where it is. And as you can see with Futu, it's been actually trendless for roughly about a month or so, maybe a little bit longer, since, you know, we'll call it February even, so about 2 months. So it's been kind of trendless, and so that tells me a lot of information too. I only do that every so often, again, just to get an essence of where the trend is. I'm gonna go ahead and take that off. And the last thing that I put on my basic charts is going to be the volume. So what I look for in volume is the accumulation and distribution of what's going on in this structure, right? So it's simple, you know. If I see big red bars compared to the day prior, you know, this is more distributive type action, right? Even though this was a green day, this is much more distributive type action going on here. Distribution big time today. So I'm looking for that. I'm also looking for low volume consolidations on pullbacks. You know, this low volume consolidation on the pullback was very enticing, even though it's below 23-day. That tells you that there's, you know, people want to stay in the stock and they don't want to sell it. So I think that is really, really important. So that's how I set my basic chart. Now, you know, as far as what I do to start marking it up, well, I like to use simple things. You know, I'm looking for areas of consolidation, right? So something like this, right? I'll use the rectangle here, and it's not a pencil line. It's a area, right? That's the most important thing, is that it's going to be an area, because supply and demand is in here. It's not at a specific point. And I also like to use the curves right over here, and it just helps me recognize the different parts of, you know, maybe a shape that could be forming. You know, for a while I was thinking this could be some kind of inverse head and shoulders or something like that. You know, with this shoulder being just really flat, basically. So I like to use these curves here, and that kind of, again, just helps me visualize what I am looking for. The last thing I'll use is going to be trend lines. You know, I like trends like this, something like, I think I was watching something like this. You know, that was an interesting trend line that I had. Yeah. And then from this trend line, we can then do alerts. So that was kind of cool too. I can then right click on the alert, and then I can just choose whatever I want. A little bit less sensitive. I like to make it intraday so I can, you know, while I'm at work or something like that, I can get a text alert, let me know what's going on, and then I can say, you know, break out, something like that. You know, put it for a few days, 4 or 5 days, and trigger, you know, maybe up to 5 times or something, and boom. So I have an alert set for this now. If it decides to rebound tomorrow and break out beyond this trend line, then I can start watching it as see what it does in this area of supply. And if it turns right back around, then I could consider entering the position. We'll see. The other thing that that I like to do also is sometimes I'll put text on there, you know, what are my thoughts. I think that's important too, if I bought it or sold it, and I'll get into that in a few minutes. But that is going to be basically how I set up my charts. And I think that the idea of simplicity over complexity is a very, very important thing, because charts should speak to you. You know what I'm saying? If you look at a chart and it should automatically say, okay, people are accumulating this, they are, you know, it's an uptrend, the trend is higher. And if you put too many things going on in the chart, then it becomes muddy, harder to see. If you're maybe trying too hard to make the chart, you know, tell you what you want it to be. You want it to go up, so you're trying too hard, basically. So that is kind of like my goal with my charts. You know, keep it simple, stupid, right? That's what it comes down to. So that's you know what I'm looking for there. And just so you know, when I look at my charts, you see this is a session, you know, for session. I like that because it gives me a better feel of the volume. But I'm a, you know, weeks to months trader. You know, I want to be in the name for a good chunk of the time to gain as much gain as possible. I do sell on the way up, and I like to use the 23-day EMA as my stop. Couple closes below is real nice. And so that's that. Now, the alerts are really important for me because I work full time, right? So I can't, when I'm working, I can't look at charts all day. You know, that's just not the way that that my life is. So what do? I use the alert system to let me know while I'm at work what's going on. My plan is pre-made, right? So I have my plan already done. So I know that if it breaks through this line, then I'm going to look for, you know, what does the volume look like? What's going on in this area? And then I already know if I want to enter it or not based on what the chart looks like. And I don't have to follow it all day. I just have to break away for 5 minutes and see if it's doing what I'm expecting it to do at that point. It really makes my life a lot less stressful because, you know, I'm not always trying to sneak a peek at a chart or something like that with a position. I also use the alerts for things that are breaking down because, you know, sometimes, you know, I don't put hard stops in. So if something is breaking through my trend line, you know, I then could put alert there, right? Create alert this line, right? If it breaks through or if it touches it, same thing, right? Same thing. So I use it both ways for breakouts, but also to manage risk on the downside over here. So that is one of the features I use literally on a daily basis that has really, really helped me actually manage my risk. You know, and I think the most important thing too is that my plan is already made prior to getting in on any position. So I know if it's going to break down, I know where I'm out. If it's going to break out, I'm considering entering. I kind of know what I want to look for that to happen. So let's go over some recent trades, and I'm going to walk you through kind of what I was looking at, and I'm going to do a bad one, I'm going to do a good one, and I'm going to look at a setup, something that I'm looking at for the future, okay? So the first one was Vuzi, okay? So here's Vuzi, and it was a half position buy on 4-1. And so what was I looking for in the past, right? So looking in the past, right over here. So, I mean, I'm seeing a ton of accumulation, from here, right? Tons of accumulation as it broke out from, this $4.40 or so level, right? And I'm not interested in this point. I'm usually buying things, usually not less than $10, usually. So again, wasn't even on my radar back here, but this is nice to see. And you can see as it consolidated, a nice low volume here. As it moves up again, volume picks up, pulls back some, lower volume, and rinse and repeat all the way up, right? So now we are in this particular range. It had come all the way up here, great volume, and you can see this nice low volume pullback, right in here. So as this is coming through, boom, boom, right, and then into here, I bought it on 4-1. So I like to buy close to the 23-day EMA. That's just what, where I feel a safe entry is. And so this has gone up quite a bit on this day, and it was making an inside day here on low volume, right? So I like that. It means, it went up, people weren't selling. It was a nice inside day. That's a consolidation day. Looks really good. So that's where I bought it, right there. Towards the end of the day is where I like to buy. And it did great, right? It did amazing. It got from, we'll say I bought in somewhere around, probably somewhere around here. So, and it went all the way up, almost a 30% increase. Now, this was a half position buy on this particular name, and it did, like I said, I was really, really happy with it, but then I got greedy, right? So it started to break out. I was like, heck yeah, this is amazing. And then it came back in. And something I learned from this chart is that this day right here should have been my exit. But because it moved up so fast, the 23-day didn't really catch up with it. And so I was like, okay, it's kind of, just kind of pulling back, even though that was a big pullback right on this day. Then it kind of kept pulling back. And you see, here's this arrow here, and volume was light. Volume was very light. And so I'm like, okay, it's just, one of these light volume pullbacks, and it's going to bounce right off the 23-day. Well, it didn't bounce off the 23-day. It kept going. And then it went right here, and I was out on 4-6, which is right over here. It was a terribly managed trade. It was, I should have, I had a huge gain that went into a slight loss. I mean, I stuck to my rules, but this is a place where I think rules can be modified, especially in a very, very fast moving name like this name. I did like it long term, and I still like the stock long term. And I think that, there's still a lot of accumulation showing up in the chart. So I won't be afraid to re-enter it if it starts to make a bottom and then start to come back up again on this right side, make some kind of new base or something. It was just, the whole market got overheated and it just didn't work out. But what I learned from this is that on this day right here, a 10%, 9.5% down day right there, even on low volume, is still a big time down day. And this is where I should have sold. All right, lesson learned. So that is VUSI. And again, this was obviously not a very good trade because I lost a little bit of money. The good news is I stuck to my rules, and it was a small loss, and that was it. All right, so that was VUSI. Now let's talk about something that went pretty good and was very rules based also. All right, so this is on semiconductors. So again, very similar as far as VUSI goes. I like the accumulation, especially as it's consolidating sideways over here. I thought it looked really good. And so as it's consolidating, I see that it is starting to move up, and I like this gap up. It closed in the top, quarter or so of the candle. Very strong close, good volume on this day coming in. Looked great. Really liked it. Entered it right here on 331. So it went up and kind of came up to this area right here. And I took a partial off up here. Now it was an exact top, but I believe it was on this day, it automatically sold about half my position right there. And I like to take profits, you know, I've snuck them up to about 10%. I may have to back that down a little bit because the market isn't as good right now. But that was roughly a 10% gain. Not roughly, it was a 10% gain from my entrance on 331. And so I took profits. Great. Well, then it started to roll over and pull back, right? And as you can see from my arrow, just that right there, perfect. You know, it started pulling back and started pulling back on lower volume. And so this is what you know, a BRB setup, right? So I call it be right back. So it went up, be right back. And then the expectations were that this moves much higher. So that was what I thought was going to happen, and what I wanted to see happen. Well, what really happened was that it started to move higher and then it rolled right over. Well, that was, you know, expectation breaker. And on this day, 419, I sold. Lesson learned from Vuzi. You know, if it breaks your expectations, get the heck out. You could always re-enter. It was below this green area right here, and it was and it went through my 23-day EMA. And as you can see from today, it followed down, you know, even lower. So even though it did everything right, the expectation was a bounce here, and this rollover right here, that was my key to get out. So this one was a much better trade because I took my 10% up here, and basically on the second half, I broke even ish around there. So I made, you know, some money on that one. It wasn't a lot of money. It wasn't great, but this is a tough market, right? You know, it depends on your market. This isn't, you know, 2020. This is 2021. Different market, different things going on. So let's go on to one I'm looking at right now. So I'm looking at Veil. So this is one that I like a lot. I've been watching this for a while, and see just a little bit longer of a time frame here. You know, going back, it had this beautiful uptrend. And again, you're seeing all this accumulation in this uptrend. Like that's what I'm looking for right in here. It's a beautiful thing. You know, it went sideways right here, and you could see how it just kind of tailed off on the volume. Again, that's beautiful. That's exactly what I'm looking for. You know, moved up higher on good volume, came back, and now it's just consolidating all this gain, right? Okay, looks great. Moving forward just a little bit and looking at the consolidation a little bit closer, you're seeing that it came down, has some kind of, I guess, double bottom-ish feel to it. You know, just really consolidation. And again, on all these pullbacks, you know, maybe a little distribution into here, but there's not much on the chart, right? You're never going to get a chart with zero distribution or, you know, any days that, you know, every day is perfect, right? But for the most part, all these bars are just nice big skyscrapers, and on the down days or the not so good days, they're just much lower. Exactly what you want to see. So what do we got here for the setup? This is kind of like a BRB setup. So you got, you know, it kind of broke out here, right? It's now coming back, and it's going to, you know, came back to kind of retest this breakout area. So what gave me pause was two things, and this is why I have not entered this particular name. One, we're still a little bit extended from this 23-day EMA. And to me, that's a little bit too far extended for comfort. I like this 23-day in price to be near each other, usually within 4%, 5% or so of each other. Let's just see how far this is. I don't even know. So price is, it's roughly 5%. Again, it just felt like it's a little too close. So I have not entered it yet. It was obviously, as of yesterday, it was, you know, over 7%. So it's coming in some. The other thing is that it has earnings, I believe, on 4/26, which is right about where this arrow is right there. So my rules on earnings is I won't buy within, you know, a week or two, about 2 weeks of earnings, and I won't hold through earnings unless I have at least a 10% cushion. So those are my my earnings rules. So unfortunately, this negates this particular setup for me. but I will be watching it into earnings. And if it holds this area and just kind of consolidates into earnings, then on earnings day, depending on what it does, or the day after, I will consider this particular setup. Again, it has everything I'm looking for. It's in a prior uptrend. You know, it went through a nice consolidation period. You see this trend is now going much higher, which is what I like. So so it's got pretty good setup for me. It's what I like to see. It's just really beautiful right there. All right, so let's go on to something that I'm watching. So, you know, I do, you know, every Saturday I start my week with my my state of the market videos on YouTube, and I really look at a lot of different intermarket analysis. And one of the things that I really noticed was this particular week was the 10-year yield. So let's talk about the 10-year yield a little bit. And I am not a bond expert. I am not a yield expert. But here's the 10-year yield. I'm going to move this to a weekly chart. All right, there's a 10-year on the weekly. And let's just, you know, let's go ahead and go back, right, all the way back. Boom, boom, boom. Okay. So, you know, looking back on the weekly chart of the 10-year, there's some really interesting areas here. So I think that this area, you know, this 3% area is a point of importance, right? This is what held as, you know, support, then was resistance, right? And then this other area down here, this 1.4 to 1.5-ish area, this was support, 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 and then it broke down from there. Now, going closer, we are seeing what has happened here. So we had, you know, in 2000, for most of the year, this was really just going down, trending down. You see this 23-day EMA, weekly EMA, coming down here. And then towards, you know, towards September, October-ish, going into November, the trend started to change on the weekly chart. So this is more of a structural change potentially in the market, right? And then there's October, you know, going into the end of the year, and it really started to ramp up. And this is where you saw it right there, right? So this was January 4th, and it was a huge, huge up day, and really it just ripped higher. Now, that was a 93.85, roughly, we'll call it almost 100% increase in the 10-year yield over a very, very short period of time, right? So it topped out was at March 15th, it looks like, right? Topped out March 15th. And now it's just kind of consolidating, kind of rolling over. You know, so about 1.5 is what I'm watching, and it kind of got close to that already. So that may have been enough, but let's see what this happens. If this rips higher again in a very quick pace, I think that'd be really, really negative on the market. Again, I'm not a bond expert. I'm not an interest rate expert, but I do know that higher rates, especially when people aren't positioned for it and people aren't expecting it, you know, it's going to cost businesses more to borrow. It's going to cost people, homeowners, more to for mortgages. Small businesses are going to cost more. Credit cards could go up. Personal loans, you know, everything we do basically is going to cost more as far as that deals with interest rates, right? So that is definitely something that I think is going to be to watch. Again, a gradual increase, and it's not so much the level as much as it is how it gets there, right? If it does a slow meander like this, you know, a lot of people tell you, well, 3% is not that big of a deal. You know, we can handle up to 3%, people may say. But if it rips higher, I think that could be a big deal. And I think that could make for a very, very, very tough trading environment. And so that being said, I think it would make growth stocks, which I like, much harder to find good quality setups and things in uptrends and so on and so forth. And we may be looking at, you know, things like metals and miners. GDX has been kind of on my radar, gold miners, things of that nature. Vail fits that bill a little bit. So that is, on a macro perspective, something that I am definitely watching. And I think that this is the chart to do it on. I think the 10-year yield, I think that 1.5, if 1.5 holds and then we get a strong bounce, I think that could be a problem. If this, is a false breakout or something and rolls right back over, I think that is going to be very positive for the bull market and growth stocks. So again, I think this right now is the most important chart out there on a macro sense. Yeah, and just because we saw a 100% increase, we can see that again very easily. And so that's what I got for you guys tonight. I hope you enjoyed it. You can find me at AlphaCharts365 on Twitter. I'm on YouTube. I have a YouTube channel. I like to post all kinds of things on there too, videos every week. And if you have any questions, again, just hit me up on Twitter, and y'all have a good trading week. Stay safe out there and take care.
Thank you for that great presentation, Jack. Really looking at some of the macro variables, not only that have happened over the last couple months, but looking forward into the summer months and beyond. Next up, we have Anne-Marie Bain to go over how she has navigated the markets over the last couple months. Let's jump right into it and see what she has to say.
All right. Thanks for that, Jake. Hey, I wanted to start taking a look at SPY because we've got markets in all kinds of gyrations, and not the broad market, but individual pockets of markets. And when we are sitting in spaces like that, this kind of rotation, which is really a sector rotation, not a broad market rotation, it really confuses many of us in terms of what we want to position and how we want to position it. And so one of the things I want to share with you that I always look at is, how does my stock behave with the broad market? And when things are moving straight up, we'll take a look at SPY right here from our TrendSpider platform, we can see that this moving average, which is the 5, it's a very tight one, it's really moving at a clip until about, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days ago, at which point it started moving up and then coming back down and then retracing all of its motion. This sort of information tells me that I have markets that are generally digesting. So interestingly, what ends up happening with high flyers, they'll also start to slow down like this. But if they're very high flyers, and we're looking at things like sector rotation, you're going to see a fairly dramatic move. And so one of the ones I'm going to look at here is one that we've been with for a long time, and that is Riot. Okay, I am going to move all those out. And as we take a look at Riot, we can see that it was doing very nicely in the early part of the year. And maybe about 6 weeks ago, I would say 6 weeks ago, it began to move sideways. Now you'll notice that SPY looks completely different to this, but what you'll see is that all of this motion that we've had in Riot is retracing, and the chart is really trying to fill in some of these gaps. If we put a volume profile event on here, and we do it from, oh, I'm so pathetic at this. Let's see. Clip, right? What we are seeing is, as we move forward, and let me hold this here and pull this forward, we can see that what the chart is trying to do is fill in this low volume pocket. And a lot of times, once we leave the point of control, we know that we're likely to fill in these spaces. And so Riot looks quite different than our SPY formation. Let's do it from here to our current space, right? You can see that we're very high above that point of control, but we've got a very big auction gap sitting right here. And so this sideways motion could have us collapse into the range, chop around for a while, and then resume the motion. So when we start seeing sideways action like this, that's the thing that makes me go, you know what? Don't buy every single pullback. Start thinking about, how does the chart look in terms of broad strength, and can we see where support is building out? And so let's go back to Riot. If we're thinking about Riot and we're looking at it, we can see that traders have moved out, but continued to try to move in on every pullback. On Friday, that was a very significant day, right? We can take a look at this and we can see that our Friday motion gives us this support action event right around this 33 area. And it's really just off of this wick right here. So the big thing to do when you come into the charts and you say, wow, everything's not going up anymore, you have to think about, when people say, hey, what's market rotation doing? It might not be an actual market rotation so much as a sector rotation event. If we take a look at the speed of tech, we can see that tech has been slowing down for quite a bit. Again, here's tech and here's the SPY. Tech has slowed down quite a bit in this area, but the SPY has continued to move up, still holding these very high levels as support zones, whereas tech is shifting off of its edges, and indeed, it had a fairly savage dip moving from February into the end of March. Now, this actually happened, this is a media event, and it was a media event because of the following. Everybody started talking about rates, interest rates. And what we know, because many tech companies carry high levels of debt, we notice that threatening rates to move higher will send people moving away from tech because they're afraid of performance for the next earnings. Remember, most of the people in the market aren't day trading from level A to level B. They're actually investing for their customers and their clients, looking for either shorts that they're going to position for a while, or longs, which is the more likely event, that they're going to pick up on deep pullbacks. So have a look. Even if you are an intraday trader, the very best thing that you can do for yourself is look at the big levels of support and resistance, right? And so here is a level I can see clearly resistance that becomes support, breaks out to a brand new high, and then pulls back. If I'm looking for a trade intraday and I'm seeing all kinds of negative motion, my thought really ought to be, well, wait a second, am I paying attention to where my price action actually held the last areas of old resistance, new support? So when it does come in, I won't be sidelined because I thought it was downward motion from a continuation space, but my daily chart told me that I needed to keep buying. This is the kind of environment that we are potentially stepping into. At the end of the day, our pullbacks are still going to be buy zones. This slope, this is a volume weighted. This is the VWAP, right? So it's a volume weighted average price. It is moving straight up. And when it's moving straight up, people are going to come into it and they're going to try and buy the bottoms. Unless we have something catastrophic occur, every bottom is going to get bought in the near term simply because nobody's positioned short. And so something else that I will do is make sure I'm looking at how many people are buying calls versus puts. Huge thing to watch. You can see where people are positioning. And though a lot of retail traders are getting involved right now, they don't really have a tendency to sell puts or even buy them. They'll buy calls out of the money. So there's still a lot of calls being bought out of the money as people continually get rewarded for buying the dip. So if you've been thinking about being short, it's really been a very painful event because every single dip has been bought. And that's going to work until it doesn't. This here, and I'm going to show you with the profile of motion. See this pocket right here? It's going to be a big deal. They're either going to come into it and bounce and then resume, or they're going to come into it, bounce, and then fail to the baseline of it. All of these gaps, they need to get filled at one point or another. It just might take a long time for these to fill because this is very aggressive motion. Look at these upward gaps. When the market runs like this, I always know there's really a three-legged chair that's being positioned on top of another three-legged chair. It's very unstable. They're not like building blocks, like these sorts of things that will give you good motion until they break and then they bounce and fail to recover. So one of the questions that I get asked all the time is, how do you manage risk? And have you changed the way you manage risk so far this year? The answer is, I have not changed. I keep the same measure of risk. And as I was mentioning earlier, speaking with some folks, that really is a problem for me because sometimes it keeps me out of really great trades. But my risk is always the same. And I want to show you something very interesting about how price changes direction. All right, so it looks like this. Let's say price action is moving up. And what I want to do is show you in a very straightforward space right here. Let's say I look at this and I go, wow, that's the point of control. I want to see if the price action is going to run up so I can buy and hold it. Anytime price action turns around, it does exactly the same thing. The first thing that happens is it fails to hold lower. Doesn't mean it won't test lower, just fails to hold lower. That's this right here. The next one is it bounces and either tests or breaks resistance. Okay, so where's resistance? You might look at that and go, you know, it could be a number of different places, but I could put it here because I look to the left and I see resistance, support, 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 resistance, resistance, and so on and so forth, right? So I look at this and I go, wow, that's a resistance zone. But let's say you want to be aggressive and you really are interested in taking this trade on the bounce. You can go to these edges and say, all right, which we love these trend spider features that do this, right? You can see how many points connect right here. And so as you're counting here, you're thinking to yourself, you know what? I need to breach this area. And when I pull back, I need to hold this low. Notice what this implies. As a trader who's maybe on this, let's say you're looking for a swing trade, right? When you look at this formation, you have to wait 1, 2, 3 days And then when this day occurs, it breaks the formation, but it also fails to hold lower, meaning it doesn't close under this low. It pops in and it comes around again. And so immediately you say the same thing. Am I failing to hold lower? Yes. Am I breaking resistance? Yes. Am I pulling back and holding my low? Here you can easily go, wow, that's 2 days. So my next day I can enter in here and my stop is going to be just under the close of the day that set my formation up. So notice we had to wait when we started counting 1, 2, 3, 4, 5, 6, 7, 8. On the 9th day, we have that secure event that says, hey, we are going to have a great job getting long in this area. You could bottom pick, no doubt about it. But if you bottom pick and you bottom pick here, or you bottom pick here, you run the risk of running your stop. And so for me, if I'm really intent on taking a trade intraday, and I want to show you how this formation works no matter what time frame you are looking at, right? Let's take a look at, I don't know, let's do 5 minutes, right? And we're going to look at today, this date for us, and we're going to look at, wow, I'm up over my VWAP. So I'm coming into my opening range where the day before I had a low and I moved up, and the very next formation gave me something that looked like, hey, I failed to head lower, right? I failed to hold lower. Where is my resistance? I have resistance that is essentially here, right? So what do I have to do? I have to wait to see how it behaves here. Who do I expect to show up here? 100% sellers. Why? Because I've made high, low, lower, high, lower, low, lower, higher, lower, low, lower, high, lower, low. If I've got a downward sloping moving average and I've had lower, high, lower, low, I'm going to bounce into resistance, and I'm usually going to meet sellers that have been defined on another level. And I certainly do. And as it pulls back, it fails to head lower. And so my thought is, this is my new support zone. So if it closes here, you might look at it and go, you know, maybe that's not my support zone. Maybe this area is my old resistance, new support, right? And so it closes below here. As soon as I recover this spot, I've got long action in play, and I know my target is up here, right? Always the same. If you're looking for a short, 1, do I fail to hold higher? Absolutely. Do I break my support or at least test it? I come in and I test it. On the bounce, do I fail to breach the highs? If that answer is no, you cannot take the straight short. Now, if you want to scalp, you can say, all right, I had sellers here, I had sellers here. Probably they're going to bring me into old resistance, new support on the way back, right? That is a very important space. So look, here we go again. 1, I failed to hold higher. 2, I test my support. Not really, I do it here, right? 3, I bounce. You have to expect the bounce because the trend has been upward. Unless it's a savage sell-off, this is always going to happen. And if the trend has been upward and it begins to bounce, as long as you do not break this high, you've got your short right here. And it's going to take you into that next area where the chart is likely to turn around. Hey, Is it likely to turn around here? 1, have I failed to hold lower? Yes. Have I broken resistance? Well, I know resistance is all the way up here. Maybe it's my old support here, but I do know that what's happening here is that I'm not going down anymore because I'm failing to hold lower. I am bouncing into old support, new resistance, and my pullback gives me a higher low, so I know I can get long here, right? You miss out on picking the bottom, doing it like this. You can try it on a 1-minute chart if you want, or you can use price action very specifically without anything else and go, all right, where's my last formation where I had, where I had resistance, support, support, support. You know it's going to come in there. You can buy that edge and move on the way up. If there's anything that I've done lately to really maximize my attention to risk, it's been doing this candle counting. And you don't need anything fancy to look at because price tells you everything that you need to know. This truly is key. Now, I was also asked, can you stick to your guns during uncertainty and when do you hold? And so here's the thing. If I'm trading a 5-minute, if it tells me, hey, your trade's not working out because you're not heading higher, right? Let's say I'm thinking of a short and I stop heading lower. I'm not gonna stay in there. I'm gonna say, okay, if it bounces to resistance, I'll take some profit now. Bounces to resistance, I'll add back to my short. And if it pulls back and gives me a higher low, I'm getting out of there, right? And that's gonna be true whether it's a 5-minute, a 15-minute, a 4-hour, a weekly, or a daily. I am going to pay attention when my patterns break, because the bottom line is this: in the trading environment, the market is skewed to be more bullish than bearish. And so my philosophy is always have dry powder to participate. And so if I get to a new high or a high that I have estimated from a Fibonacci or something like that, I'll say, you know what? I'm going to take some gains. And then if it comes back, I'll add back to it. I'm not here to say, hey, I'm going to stay in here until XYZ full bore, because I don't want this to happen to me, because I'm not only trying to protect my physical capital, I'm trying to protect my emotional capital. And that's very important to me. I don't want to get to a space where I become mentally or psychologically compromised because the fear and cortisol floating all around in my brain short circuits my prefrontal cortex, and I can't make any logical decisions. I'm just in fight or flight, and that is not good for me. So many times I will get out before a high breaches because I'll see things changing in the market or changing in the formation. And so I'm always on the side that is closer to risk averse than risk loving. That has its own double-edged sword, right? If I'm seeing the market moving like a moonshot up into this space, once it gets up here, I'm going to say, wow, that's my old resistance. I want to take some profit. And if it doesn't come back significantly for me, which I would imagine it would come back to here or maybe even to here, and it doesn't come back and it continues to move forward, I sometimes will have minimal exposure as it moves up. But I'm not here to eat an elephant all in one sitting. The market is a journey. It's not a place for you to hit home runs and leave. Hey, listen, if it happens to you, awesome. But for most of us, it's a grind and a move into the space. So here's the thing. Trades don't work out all the time. But for me, the only thing I'm asking myself is, if you take this trade, what's the worst thing that can happen to you in terms of where you're setting your risk, right? And so if a chart is moving really fast and I've got my 5 sitting up here, I will look at old support of the 5 and I will, old resistance, new support, I'll try to get involved here, get myself to a brand new high. And then as soon as I start seeing wicks like this, I'm going to start covering, because wicks like this don't mean there are more buyers. It means that sellers are doing what they can to push price action into deeper support, at which point, old resistance, new support, I can get back involved from that particular perspective. And so I'm always looking at where my trade, if the trade goes badly, what do I have at risk? I have no idea where the market's going to go. I can estimate that, but I don't really know. What I do know is if it gets down here, I'm taking my lumps. It doesn't matter if it bounces, I'll reset and continue again, because the only thing I have control over is where I define my risk. And if you want to be a trader that performs time after time after time, 2 things you're going to have to work on. One is, am I holding myself completely accountable to process? If that answer is yes, you're in great shape. The second thing is, am I accountable to myself or someone else that if I break process, that there is a reckoning coming on the other side of that? And for most of us, we don't hold ourselves to process, and consistency is the last thing that we can put at the very top of our skill sets, right? Most of us are very inconsistent about when we work out, how we eat, what we drink, how we do anything. Very few of us have very consistent protocols that we live by. We just like to fly by the seat of our pants. And you simply cannot do that and survive long term in the trading space. It's just not viable. Now, how do I know that? Because I've been trading for almost 2 decades in the market, and I've seen literally thousands of people come and leave because they don't know how to hold themselves to a measure of accountability, and they don't know how to be consistent with process, because what they do is sit back and say, you know what, I'm going to try it this way, or my gut says I'm going to do this, or nothing wrong with gut, but you've got to verify that you are correct and make a line in the sand where if you are incorrect, you're going to know exactly what's going on and you'll be able to cover in the short term. All right, that's it for me. Thanks for having me on. Take care.
Thank you, Anne-Marie, for going over how you really stick to a process and focusing on that process side of trading. A lot of people forget that having a process is the #1 thing about trading that really keeps you in line. Let's move on to Options Mike and see how he's been able to navigate the markets during this volatility.
Thanks, Jake. Good evening, everybody. Good afternoon, whatever it may be. This is Mike. Hope everybody's doing well in this market. And today we're going to talk to you about different strategies and how I basically negotiated this market this year, and what I've done and what I haven't done specifically, because it's you're looking for different things here, right? You don't want to just deploy money for no reason. And the best way to start this when we go looking at the strategies to look at the S&P 500. That is the benchmark for the indexes, right? This is the 500 of the top stocks. This is the biggest one. This one usually shows us the big move in the markets. And as we're doing this, we're at all-time highs. and the market's holding in strong with a nice upper level flag. But to really tell the tale of this tape and where my strategy evolved from this year, you kind of have to back this up to last March. And so we're going to take a little stroll back in time here to last March when we had this big, you can see it in here, 30% correction in the markets. And there's a reason I'm bringing up the 30% correction, because since that event ended last March with COVID, we have yet to have a correction in the S&P 500. Now, have we had little pullbacks? Yes. Have we had some chop? Absolutely. But we haven't had a correction being at least a 10% down move. That's kind of interesting because typically you get 3 to 4 of these in a year. We're way overdue for one, and the sentiment in this market is extremely bullish. So these are the type of things that sometimes give me worries, right? Makes me pause. So one of my thoughts was I wanted to deploy heavily, I've got some big time in cash, into a correction that we have yet to get. So, don't feel bad. You're not the only one looking at it. So let's just start back in time. And off our March lows, we had this big move up until we came into this pullback zone. And if you come back into the period from last September up until the beginning of November, we had this choppy W pullback zone where we pulled back about 5 or 6%, never got down to a 10% correction in the markets. Ultimately, you can see we held the 100-day moving average in here. Market remained very strong. And at that time, we were coming up on a big event in the United States, and that was the presidential election. And the market was extremely concerned at that time about Trump losing, Biden winning, and what would happen with control of the House and the Senate. And the market, if you look at the action going into the election, led us to believe that it wanted to sell off because it was nervous that Trump was going to lose. Funny thing happened on that. As the market was selling off a couple days before the election, the market decided, no, I'm not selling off. I'm going to start running. And we actually started to front run the election and then ran all the way up into the turmoil period where we didn't really know who was president for a week or so, right? It was about a week or so before we actually knew who was president. So this here, and the reason I'm pointing this area out, and here we could put it in a little box here. Oops, hate when I do that, right? Right in this area. The reason I'm pointing this out, because this represents the biggest corrective type activity we've had in the S&P 500 since last March. Is this bad or good? Well, it's good if you're a long-term investor and you're holding stuff. From a trader, it's not so great. And for markets, it's not a great thing. Pullbacks reset these setups in the markets. They also bring things back into more alignment. Right now, we're looking at valuations starting to get stretched in this market. So after this run up in November, and then we had this run again, let me remove this for you. Okay, we had this nice long run up into the end of the year. I decided that I was not going to deploy cash until we got a correction. Well, it's now end of April, almost May, and we've yet to get any kind of correction. We've only been able to get a 5% pullback in this market. Very, very frustrating. So my strategy this year was to sit there and sit in mostly cash and day trade or short-term swing trade. And that's what I've been doing. And if you look at the S&P 500 here, you can see the incredible strength that we've had for this year. This red line represents the 21-day. You notice how few times we've been below that. This line right here represents the 50-day. That actually is acted mostly as support. At this point in time, you can see now just how extended we are starting to get off of everything. And what that means here is that the market is starting to get into a very extended zone. We are well off the 200-day now, which is down here at 362. The 21-day all the way down here, also pretty far off of it. And we've left a bunch of small little open gaps behind as we continue to move up here and flag. Now, does this mean the market's going to come in? No, it doesn't. Markets can stay irrational a lot longer than most people can stay solvent. That's one of my favorite sayings. If you think about the Big Short, that movie, how many people, these guys who were trying to short the markets back then and short because of the rates, they almost all went insolvent before the market finally came in. They made a lot of money. But you have to be on guard here, and you have to be aware that we've moved way too far, way too fast, and this market's getting extended. Valuations are getting extreme. Okay. So how do you handle a market like this? Well, you have to watch for the rotation setups. And if you look what's going on and we go back to the Qs and tech, we have a very, very different chart that emerges. The Qs are just shy of all-time highs today, and just starting to come back up. And in the Qs, we actually got a 10%, briefly, a 10% correction back here in the beginning of March timeframe. What's been going on in this market is we've been seeing a lot of rotation throughout the year. And if you look what's going on, tech is just starting to come back into vogue now as we go into one of the busiest earnings weeks of the year. So, this is shot a couple days before you're going to see it, but this is the week we're going to have names like Tesla and Apple and Google and Microsoft and AMD and Amazon, big tech names reporting this week, which are really going to help decide the fate of this market, where it wants to go. So when you look right here, you see on the Qs, you have a very interesting pattern. You're not as extended. You're not as overbought. You have a cup and handle formation that's formed here right at all-time highs. And the market's saying, okay, maybe we're going to rotate back into here. Let's look at some other charts. What really led us for most of this year was the value plays. What do I mean by that? You go into small caps, financials, diamonds, big stuff. We'll look at this. But look at this move in the IWM. And if you back this up, the IWM took forever to get back to the 52-week high, and it had been lagging for years. So when you look at this chart and you take note of what happened is, once we came out here and we gapped up, and I want you to notice what we did. You see this high over here? Let me go put some box in here for you. Right. Notice this area right through here. Right? This was the previous 52-week high there. We gapped up into it, above it, and held it, leaving an open gap below it, showing incredible power on that move on that day. And once that happened, this blue line represents the 8-day moving average. You can see the change that took place. No longer was tech leading, right? Back in November, no longer was tech the big leader. Now it was small caps, and the small caps ran. Barely pulled back, touched the 21-day, ran again, pulled back, held the 21-day, ran again. It wasn't until we got into February where that rally slowly decided to fizzle out. And here we are today, right, after this big move. And you can see now we've created this kind of consolidation range on the Qs. And you can come in here and say, right now, I'm sorry, on the IWM, we're in a channel, right? Basically sitting here, going sideways in a channel, consolidating. And consolidation's good, right? Consolidation allows things to catch up. And you do have a little head and shoulders top pattern here that's developed, but it hasn't really triggered. And this was the leader. So for most of this year, small caps were the leader. Starting in February, small caps suddenly became weak. They started to give up the ghost. What else ran? The financials. Look at the move in the financials. Again, another one, gapped up, took off, huge run. So we've seen in this market constant rotation year in and year out. And right now what's happening is the ones that led us all this year are starting to tire out. The IWM, the financials have gotten tired. You switch over, you look at large caps, the diamonds, the industrials, right? Look what's happening here. Diamonds also led, getting tired up here, going sideways. So we're starting to see a change in character in this market. And this is where you start to ask yourself, what's next? Who's going to lead next? Is it going to be tech and the QQQs? Right, we've looked at that. Are we going to see this become the leader? And certainly the Qs are poised. They're not as extended. They could lead, especially if earnings are great. Is it going to be the semis? With all the talk of the chip shortage and everything, isn't it interesting how the semis have yet to hit the all-time high that they put in back over here, back in February? So the semis could poise to lead. And I don't know about you guys. I love when the semis lead. So what this market has done this year is has rotated sectors and areas and moved on to different ones. So it's created a very, very wild year. So coming into this year, my strategy was to deploy big cash, and I do have a lot of cash I want to deploy into a correction, which we have not gotten. So my process came at that point. I'm going to day trade, and I'm going to focus on short-term swings and names that are in play. And what I like to do that is I use a couple different things. One, I look at technical setups on a daily basis. The other thing I look at is volume in the name. And then the other one is option flow. These technically tell us whether a name is in play or not. And One thing this market has been very good about through the entire move up is giving us names to play every day. Even when the market has weak days, generally there's money to be made to the long side because this market's still so bullish. Names are very strong. Even when you look at the spot S&P 500 on last Thursday, we had that big weekday, right, on the news of the possible 40% plus on the capital gains tax. There were longs to be had that day. So I have focused almost primarily on looking for names in play and trying to find the strong names and where to go. And that is something that, I think will serve a lot of people. Look for the strong names, look for the great setups, look for what's in play. And, if you look around the market, you can see, and if you start looking at charts, you can see there's been different names to play in different, no, it's not GME. One letter too many, GE. So, GE was one of the names that was on my radar this year. And, you can look here on this chart, and here, if you look in here and you just kind of look at this here, on these days here, look at the volume candles, right? Here's your average volume. It's so low down here, right? The low volume. Look at the wake up candle on these days and this push, right? Day one, day two, beautiful move in this name, beautiful move higher. Day three was a gap up and pulled down before it came back and pushed up. So, if you're watching option flow, you're watching volume in the names, it's going to tell you what's in play that name. And that's really what helps out. Now, the technical setup was here as well, right? You had it pulled up, pulled back, was riding the 8 and the 21 day. I love when names pull back and hold the 8 and the 21 day. It shows incredible strength there. So the name was set up, and all it needed was the fuse to be lit. And that came here on this day, on the January 11th, took off, 1, 2, 3 day move, could have gotten in and out of it, pulled back, went sideways, created a gap and go for another 2 days before it finally came in, for eventually getting all the way up here to here. We're going to probably come back and focus on GM a little bit later. So lots of names have been in play this year, depending on what you're looking for. I know you guys all love Tesla. Tesla's very good at signaling days when it's in play. You look back, you look at the volume on the candles. You can see the size of the moves, whether it's the upwards or the downside. And you look at the volume setups here on this day, on January 7th. Look at the size of the candle that day. Whether it was the volume there, sorry, the 6th or 7th, yep. Okay, volume, not great. One of the other things I always look for is options flow. When they want a name, they come all over it. So in recently names, ideas. I know a lot of you guys like to play with these little names like Clove. This name is fabulous for telling you when it wants to be played. All right. On this day here, it made nice money on Clove. Why? The volume was off the charts. Within the first 10 minutes of the day, it was already at like 20% normal average daily volume, and the call buying was through the roof. And that's what you love, when you can see that coming in. A day like that, they just come for the name over and over again. They're hitting options, multiple strikes, multiple expirations, at the money, out of the money, all over the place, telling you that name's in play and they want to be involved in it. And then it gave another day of follow through. So for me in this market, my strategy, very, very simple, guys, is to focus on good setups that have volume and have option flow. One thing I do try to avoid is trading names that can get me in trouble in a market like this. Names that are very loose, names that do not have good liquidity and options, and the spreads are wide and they don't trade a lot of volume. So many people constantly talk to me about CMG, and I love CMG as a company. I think they're a great company. I love their product. But for me, this name trades now a couple 100,000 shares a day. So it's not touchable with stock. On options, most strikes sometimes, one thing you can tell you about CMG is when you go out and you look at the option flow in it, and here's a treat for you guys, right? When you can see your order, right? If I was to buy one of the April 1480 calls, the April 30th here, you would see my order tick here. You never want to be able to see your order unless you're a big fund. That's different. I'm talking about, your home or whatever. If you can see your order, there's no liquidity. You have $5, $4 spreads on the names, right? There's no liquidity. It's very hard to get in and out of these options. So one thing I also focus on times like this, when the market refuses to pull back and I'm not comfortable sitting in a lot of positions, is avoiding names like CMG, which can be difficult to get in and out of. And, you can lose a lot of money very quickly because you can't sell. Remember, the market maker doesn't have a buyer on the other end. They're going to really hurt you on the way out. they'll just keep dropping the ask and the bid and dropping the bid and to get out of it if you're in calls, or opposite on puts. So very difficult. And the thing is to focus on names you can trade and to look what's in play. So for me, sectors very specific. What sectors are in play? Where's the money flowing? What's been in play? What's moving? And then you look to see, are we extended? And the one thing I always tell everybody is when you're trading things like the financials or the SPY, is these never like to get that far off the 8-day. Anytime you start to get close to that, well off the 8-day, like if you look at the XLF right here, right, the blue line being the 8-day. You see this day when we opened up here this far off the 8-day, that was a no-go for me. I'm not going to take it. The risk reward now changes out of your favor, meaning learn your stocks. For me, the 8-day moving average is gold. Some of you guys like the 9, some of you like the 10. Use whichever one you prefer. I like the 8-day the best. But whenever you get this far off of the XLF, you're asking for trouble. You're asking for trouble, and chasing it at that point is the risk reward is no longer in your favor. If you're patient and you want to get in it, you wait till it comes down. You had 2-day pullback, went below the 8-day, then popped up, and then it gave an entrance when it took out this area up here, or anytime it touched the 8-day in here. And that's what you have to do, is look for, saying, try not to chase these names as they get very extended. The S&P 500, very, very similar. When this name starts to get extended off the 8-day, like this day here, when you're over 10 handles off the 8-day moving average, that is not the time to be chasing into anything there. Notice what it did. It gapped up, closed, and then it spent a couple days going sideways, allowing the moving average to catch up before starting to push again. So little tricks like this in a market like this will help you. Now, when you have something different like this and you get this big move, right down here, again, bring it to your highlighting, to your attention, right? Nice move. First day took back the 8-day moving average. Second day popped higher. Day 3, day 4 wildly extended. Day 5 inside day. Day 6, I don't remember the reason here, huge gap up. I mean, this is if you're a swing trader or a day trader, you're taking profits, maybe cute shorts if you feel it, but you're not chasing in this action, right? At that point, you can look where 347 was the 8-day, and we're up here at 364. To me, little things like this, guys, may save you a lot of problems as we move forward in the market, especially when the market starts getting choppy like this. So again, my strategy for this year is wait for a correction to deploy heavy cash into and take big time swings and long-term positions. And secondly, is to sit here and to make sure not to chase names that are extended. Day trade, swing trade, take good setups with technicals, good volume, and that works out very well. So let's talk about a couple of trades that worked this year and some that didn't. So let's start off with really what turned out to be a fabulous trade. And that was in Gilead this year. So Gilead right here, we got long calls in my room here on this day, not on the bottom, probably about halfway up it. We got long and we went out, I believe it was the June 570 calls, June 70 calls. I have to go look. Let me go see if I can pull that up for you real quick. I think that I always keep it, by the way, always keep a trading log. I keep a log of every trade I have. I do. This way I can find it. It's in my hair. It was the May 6750 calls. So we got long the May 6750 calls on this candle. Notice it was right at the very end of December, last day in December. Plenty of time. When I want to swing and I want to be able to sit in something, I'm not going to dink around. I want time. I want time to take advantage of the move that may come so I can maximize my investment. Okay, so what happened here? Day 1, beautiful day 2, inside day 3, and day 4 went. Day 4, you notice we pushed up here into the 100-day moving average. On that day, I think I sold some. For the first time, I started taking some profits. We went sideways and chopped around for a while. Then we gapped up and got another big move. Again, up close to the 200-day. At that point, somewhere in here, I sold out of all my calls. And you're saying, Mike, why'd you sell out up at 67 area? Well, because we had come into an area of resistance. The 200-day moving average identified could be a problem for this name. We're also in an area of decent volume. I said, this may have a problem getting through here. Pull back, pushed up a little higher, ultimately pulled back and has been going sideways ever since. So that was a nice trade. That was a nice swing trade that lasted about a month. Nice one to be able to sit in. And the gift and the key of that was having time. Another thing I'm always going to tell you guys is very simply take profits as you go. You don't need to do all or nothing. You can always get back in. You can always add calls back on a pullback or stock back. If you're constantly shuffling your feet and you're taking some profits, you can't get hurt as badly. Put a profit stop in place. Once I was up nicely on these calls up in here, I had a profit stop. I wasn't going to let this trade go red, and that's something that's very important. Too many people just sit in things and they just say, oh, well, it expired worthless. I very rarely let a call, an option play expire worthless these days, because why give them the money? 50% stop, profit stop, good enough for me. Okay, let's talk about a trade that did not go so well. And this one was recently. Walmart. Boy, Walmart is quickly getting on my do not touch list. This name is just driving me nuts this year. So on this day right here, we had a big push up. There was news, and they bought a ton of the May 150 calls. So me being who I am and saying I like it, I decided to go in and buy some of the May 150 calls because I like the move, specifically because you had this gap sitting here that could be filled. I'm like, yep, they're playing for that gap fill. They're playing for a move up here to Trend Spider puts at 144. I actually treat gaps differently than most. I don't treat it as the bottom of the candle. I treat it as the open to the close. So I saw a possibility for a move all the way back up to the 148 area, close enough for the 150s. Just a different perspective on things. For me, a gap is from the open of one candle to the close of the close of one candle to the open of the next. So I treat things a little bit differently. That said, what happened is we came in here and we started pushing in and pulling out and pushing in, tested the 200-day, held, pushed up, went below the 200-day. At that point, I finally got tired of this trade and said goodbye, only to see 3 days later put back into the gap. Now, the calls never really got profitable, and here you're out. So something else to learn. Why did I get out for a loss here? I took a small loss on it, not a huge deal. Because if a trade is not working, there's no reason just to sit in it. And that's the one thing that I've encouraged you guys all out there to start thinking and looking at. If you're in a name and it's not working and they're chewing your option premium, get out. Now, if you're in stock and you don't care, that's a different story. But if you're sitting in options, don't let them chew your option premium to shreds. That's your money. Get out. Set an alert. Set an alert of where to get back in. So, in Trend Spider, you can come in here and create an alert right at the gaps, right? And say, come up here, a touch of the gap during the session, or you can even go down to, like I usually go down to a 10-minute chart or less, and just say, okay, just tell me. So I'll get an automatic desktop notification. Now I know I have an alert in there. That's when I would want to get back into Walmart. Plain and simple. At this point, this name is dead to me until it gets back up to that gap. There's no reason for me to get into it. Even today, they bought a ton of the weekly, the May 14th 141 calls, and it's closed near the lows. I have no interest in it. So remember, not every trade is going to be a winner. Not every trade is going to be a loser, a great trade. But, it's about managing your trades and doing well as we wait for this market to finally pull back. And at some point, this market's going to correct, guys. Anybody out there and you see on people on Twitter or FinTwit saying this market will never correct again, market can't correct, please don't listen to them. They don't know what they're talking about. Markets always correct. This will happen. Just be patient. So let's talk about some things I'm looking at when we do correct. And I'm going to give you a couple different names here because these are things I've worked on all year long and I've talked to my members about. And I did actually every year I do an outperform list for the name for the year. And GM was one of these names on my list. And it took off right here back in the very beginning of January. Didn't even get much time to get into it. And I love what's going on with GM. I love the story here. I love how they're setting themselves up. That said, I do not want to buy it up here close to all-time highs. Where I like this name now, if we get a pullback, is I would start considering if the market corrects and it holds into this 48 area, 49 area, I would look at it there. And then I would really like it even more if it came down here into this 46.50 area and topped off on this candle. So if it came down to here and we get a market correction, I would be looking heavily at a name like GM there. I think that could be a very good name as we move forward. Not to be outdone, I want to have some exposure to EV names other than GM. And I'm thinking lithium or LAC. So what you need to know about these names, why lithium for me? Lithium for me because everybody's going to need, every car's going to need lithium batteries, right? And that's going to be a huge amount of money going into that as every auto manufacturer goes out to that. So lithium already starting to wake up. If, again, market gives a correction, this thing can come down. You look at the volume shelf, you may be able to get this thing all the way down here around 11 or 12. That would be sweet. I would love to pick up LTHM around there. The other one I really like in this space is LAC. What you need to know about LAC, and this is important, is LAC is pre-revenue. They will not have revenue to next year. So this is a much more of a speculation play. And what I mean by that is, think about that. This could pull back. And if the market corrects, for me, this one, anywhere around this 11 area becomes an extreming buy. Again, it got close here last week. I had to trigger on it. I'm trying to wait for a correction. Really like this one moving forward. I think this could be a big winner as we go forward as well. Some different thoughts on playing the EV space rather than chasing names like FSR, which has no revenue for at least another 18 months if they make it that far, right? So just trying to change the thought process here for you guys. One more, give you guys three to look at. Intel this year was a name I loved in January. I thought you could buy it versus this 45 area low. Unfortunately, it didn't wait. It took off beforehand thanks to some activist investor getting involved in it, pushed up, gapped up with the new CEO, and you got this big move. Okay, so now we just had earnings and you have a new gap that's developed here and you're getting the beginnings of a corrective phase. I like the long-term story in Intel. If you get a correction in this market, here's what you watch for. You see this big void in the volume profile here? If it drops down, it can come all the way down to 50. If you can get it down around 50, that's a place I would look to try to enter into Intel for a long-term hold and trade. So guys, my name's Mike. You guys know me. I'm out there on Options Mike. My website is smartoptiontrading.com. I run a Discord room with Zoom and private Twitter feed. Every day we're looking out. We're looking for volume. We're looking at the options flow, the news, what's in play, and the technical setups. We do this Monday through Friday. Very welcoming community. They're very helpful for new traders. They have a lot of very experienced traders in there as well. Would love to have you guys sign up with me. You can visit my website and join me or follow me on Options Mike. I post so much stuff for free out there, including a free video every week. Thanks for joining me, and turning this back over to Jake. Catch you guys soon.
As always, great presentation by Options Mike, really focusing on switching it up as the market switched up with that volatility, changing from a swing trading approach to more of a day trading approach. Now let's move on to our last guest, Peter Hegedus, and see how he has really navigated the markets over the last couple months, dealing with that volatility and how he's looking to deal with the markets going into the summer months.
Thanks, Jake. Glad to be here. Peter with the Trader's Path, talking about ways we can adapt to a changing market and deal with markets that can be rather fickle. And the way we handle things is really a three-part strategy, but all of it revolves around risk management and the TTM squeeze for us. So we use the TTM squeeze to analyze the overall market. We use it for a swing trading strategy, and we also use it for day trading strategies that we're going to give a quick walkthrough on. But I think the first thing we're going to talk about is just what is a TTM squeeze and why is it important? How does it work? To understand our strategies, I think it's important to have a basic understanding of that. So let's go ahead and pull up an example here. And we can see an example here with Apple, where we have a TTM squeeze on the daily. And basically, there's two components to the TTM squeeze indicator. One is a momentum oscillator. So you see these yellow bars below what we call the zero line, and you see these blue bars above what we call the zero line. And we want to pay attention to that because typically when we have momentum pushing down towards the zero line, or pushing down away from the zero line below, we tend to see price action that's going to be negative, right? And you can see here in this case, there's some negative momentum and there's a big pullback in Apple. Conversely, when we see momentum pushing up, we tend to see momentum up and price up. Doesn't always work perfectly, but kind of a rule for us. We don't want to go long against negative momentum, and we don't want to go short against positive momentum. Second component of that squeeze is what we call the squeeze, and that are these dots that we see here. When they're green, we do not have a squeeze. That is squeeze off. When these dots are red, that means we have a squeeze on. And that's where we get interested, is when we see that TTM squeeze. That's always telling us to pay attention to this name. And why? Because with these squeezes, we're typically in a consolidation pattern of some sort. So the way that works, what are these, what makes for the red dots? It's the relationship between the Keltner channel, which I'm going to go ahead and turn on, which are my yellow lines there, and then the Bollinger Bands. And let me turn some other stuff off here so we can see everything better. And you can see now, when we had this squeeze, the Bollinger Bands pinched inside the Keltner channels. And that tells us that everything is setting up for a big move. The Bollinger Bands have become very tight. They've come across inside that Keltner channel, and they're setting up for that bigger move. And you can see here in the case of Apple, that resulted in a big breakout out of the Keltner channels, and price action follows the Bollinger Bands up out of that channel. So that is the TTM squeeze that really kind of informs everything we do. That's how it works. Beauty of it is I don't need to look at these Keltner channels and Bollinger Bands all the time. I can simply watch whether I've got red dots or not on the chart. And we tend to be very focused on charts that have those red dots, telling us that there's some consolidation going on and some good things are about to happen with this name. So that is our TTM squeeze. First place we use it with is with the market. So we always, the market's constantly changing. I've spoken before when I've been on TrendSpider about a book called Who Moved My Cheese, and we feel that happens all the time in the market. We have markets that can be really strong trending markets, either up or down, or we can have markets that are choppy. And we can have markets that may be in a bottoming process. We can also have markets that may be in a topping process. So it's very important for us to understand where we are. When I've got a strong trending market, whether it's up or down, I think it's a great time to be able to focus on swing trading, put most of my effort, most of my capital to work there, and simply follow the trend. But when I have markets that are kind of doing, and we've seen, you've seen a lot of this here in 2021, that are doing this, right? Just kind of making these big swings back and forth, and eventually doing a lot of sideways movement. That's always something we want to handle a little differently. And it's going to change how much we want to allocate of our actual capital and also of our mental capital to swing trading, right? When we get that clean trend, and you can see examples all the time of that very clean trend here back in this late spring, summer, and fall of 2020. You've got a clean message. You can even see we had very good success at the Trader's Path back in this COVID pullback, because we had a very clean downtrend to work with, and we know how to handle that. But when we see something that's kind of choppy, we have to adjust our strategy accordingly. And one of the big things we do to do that is we're going to alter how much position size we trade with, right? So when I have a choppy market that's maybe sitting on all-time highs that seems very bullish, but the pullbacks can be pretty painful, we tend to go with smaller position size. And then we also tend to focus more, change our focus more to day trading versus swing trading. And we'll still swing trade. We're still going to take shots. But it's really important, as you see the character of the market change, that we don't just repeat doing the same thing over and over again if we're constantly getting chopped out of trades. And also with that too, as you adjust your position size and you get in a market where maybe you have rising volatility, you can change your position size and give yourself more room on a trade. Last but not least, I would say you also just need to pay attention to the character of what is working. So I've seen bear markets where breakout trades work great. We're kind of currently in a bull market where breakout trades are not working well at all. So you want to adjust your strategies and you want to adjust your approach based on what you're seeing that's working. And last but not least, I think a theme really for the last probably for the last year almost at this point, post the big 2020 drop, has been rotation. So we also want to pay attention to what sectors are working and what sectors are not working. So we look for, we like to trade some biotech catalyst trades. But boy, if I take a look at the XBI, this thing's just looks like a ski slope here and is really struggling to hold key support. So that's probably a sector we're going to shy away from, and we're going to look to find those sectors which are working. And then I think the last thing I will say with the market and how we approach that is we want to pay attention to a couple things. One, we do actually want to pay attention to this TTM momentum and whether or not we have a squeeze. So as we looked this week here, you can see we saw these momentum bars get really high, get into an area where they tend to get tired and want to pull back, and started to roll over yesterday. So we saw those start to roll over. And when we do that, we watch key support areas and see, are we going to find support? Are we going to find resistance? And let that inform whether we want to be focused more on long or short trades, or whether we want to take more cash, more capital off the table and go to more cash because we could see a pullback. And the key for us is we're never going to call a top. We believe that's a fool's errand. But we are going to watch areas of interest to see what happens. And one of the key things we like to do with that, and these are all my bright purple lines here, the thick purple lines, is use anchored VWAPs and look at key swings low and high and see if those anchored VWAPs hold. You can see the one that was provided a bounce today, but certainly something we're going to continue to watch is this VWAP anchored to this swing high here. And if that breaks down, we're probably going to be a little reluctant to go heavy long on swings, and may even look for some short opportunities on our swings, because there's a lot of room down then to my next major area of interest, which would be my SMA 20, which is right in confluence with VWAP anchored to a key swing low. So we think it's really important, before we talk about our swing trading strategy and our day trading strategy, both revolving around TTM, that we talk about how important it is to handle and navigate these types of markets, to understand what the current market character is. And right now, the current market character we're seeing has been relatively choppy. A big push, arguably too far, too fast. That's showing us some signs that it may be a little tired and need a little bit of a rest here. So that's kind of step one of our strategy. Step two of our strategy is our swing trading strategy. So this can change a little bit based on that market characteristic. But we see a market right now that's really difficult to trade breakouts. And we find it much, much better to look for names that are consolidating or are back testing a key breakout area or back testing a key area of interest. And we find the best way to look for those is to look for the TTM squeeze. Why? Again, that TTM squeeze is going to really quickly give us a list of names that are consolidating. I don't need to scroll through 400 or 500 charts. I can simply run a scan through the TrendSpider market scanner and really a pretty simple scan. I mean, there's not a lot to it. I can show everyone here, or if we look at our TTM up increasing momentum scan, we're simply looking for something that has a TTM squeeze. We have some different, and we want the preferred TTM up. That means we're looking for longs in this particular scan. We have a separate one for shorts. We want the, we want the price action on the day to be green. We have some volume parameters. We have some price parameters. You can certainly adjust those. But basically all we're looking for is we want to see that squeeze for at least 2 periods. So we want it 1 candles ago and 2 candles ago. And then we want the TTM momentum to be greater than the previous day, which means that it's trending up. And when we do that and run that scan, I'm not going to go through it all. I've already pre-run it here. We get a list of names that are all in a TTM squeeze. And that's really at the start of it is the crux of our strategy, is looking for those consolidating names in a squeeze. And then from there, it's a matter of, going through these charts and looking for various patterns that we like. So I'm not going to go through each and every name here on the scan, but I'll go through a few and just talk about the types of things we look for, right? We want to see that squeeze. We want to see that momentum pushing up here to the 0 line. And then we're looking for certain patterns. Now here, this is okay, but it's kind of a V reversal, which we find to be really difficult. So probably not the A+ type of setup we're looking for. I go through a couple others. BKI here, nice TTM squeeze, but that momentum is inconsistent and it's trapped below its SMA 20 for now. I'm not really interested in playing a reversal in a name that's trapped below the SMA 20. I go through DEI. Again, nothing exciting from a pattern standpoint, decent squeeze. But then as I move on the chart, I can come to Clorox and I say, wow, that's kind of interesting. I've got a little bit of a rounding pattern that one could also say is a bit of a sloppy head and shoulders with a neckline up there. And then I start to look for other reasons to either keep this on my watch list or throw it off. But my favorite thing to do in addition to a TTM squeeze is then to start to look at my anchored volume profile. So first thing I would do on a chart like this that's had a big pullback but is now showing some signs of reversal with a nice squeeze, I'm going to put an anchored VWAP on there. And you can see now this anchored VWAP was resistance through here, tried to pop over, failed again, but it's now reclaimed it. So it's had a push through, made a higher low than before, kind of that sloppy inverse head and shoulders setup. And now in a day where the market was really weak, has made a strong push up and has taken out that anchored VWAP level. So as we watch these names and talk about how we handle changing and difficult markets, right now, we know that I've said earlier, breakouts aren't working great. But if I've reclaimed this key area of interest here, which is that anchored VWAP, what we would do with this name is put this on our watch list and say to ourselves, is there a risk reward entry that makes sense? First thing I would say, buying yesterday's high is not that entry. There is nothing but wicks above recently. So we would look for a pullback and look for this to hold that area that was, has been resistance a lot recently. And then we simply use the TrendSpider position tool to say, boy, if we were to get an entry on a pullback down close to that area, set a stop that would make sense, which would for me be that below that low close. I don't want to see it close below that low close, and then look for a target that makes some sense. And to me, that would be this supply zone up here from my anchored volume by price. I've got a better than 2-to-1 risk to reward on that trade. So, you know, in a market that's always changing and always difficult, is it going to be that bad a thing if I risk $4 and the market's choppy and I get stopped out when I have the opportunity to make 10 to the upside? And that's really, you know, the crux of our swing trading strategy. We're always looking for that high risk reward. We want a minimum of 2. Ideally, we'll see a risk reward more, you know, closer to 3. You know, anything above 2.5 we think is just fantastic and can really help you survive and keep your capital when you see these choppy type conditions. So a couple other names that came up on our scans. You can take a look at this ALKS here. This is another one. We've got a bit of a rounding pattern. One could also argue a bit of a sloppy double bottom here. Found an area of interest with this SMA 200 where it's bouncing, and we have a long TTM squeeze that is now pushing back up through the 0 line again. So again, the first thing I would do is check to see what does my anchored VWAP look like, and look at that. Anchored VWAP through here was resistance. Now anchored VWAP has pushed through. Again, I don't want to buy the wick here. If I wanted to trade this name, I'd be looking for a pullback closer to that anchored VWAP level and look for a push up into another resistance area, which would be that supply zone above, and probably set a stop on a close below that SMA 20. And again, that gives me better than a 2-to-1 risk to reward. So, you know, for us really with swing trading, particularly in a choppy market, we don't want to overstay our welcome. We don't want to be too patient. We just want to make sure we're able to find the best risk rewards. And I'll look at one more example here. You can see Fizz. I've already got my anchored VWAPs all set up on this one. Really long TTM squeeze, long rounding pattern. We like that rounding action. We like that we've got really solid support in this great big volume shelf right here. So we think, you know, any dip there, we'll probably find some buyers. We threw an anchored VWAP to this little swing high here, which so far still above where we're at. Then we also threw an anchored VWAP on that 52-week high back there. And again, here you can use the position tool to say, okay, if I get a little pullback in this name, I don't want to be buying the wicks. I don't want to be buying there. This is not a market where we have a breakout character to the market. And I get a push up to anchored VWAP, set a stop on a close below the lower anchored VWAP and the SMA 20. How does my risk reward look? In this case, it actually looks really good. I'm better than 2.5 to 1. I'm risking $3 to make almost $8 in this case. So those are the types of things we look for in our swing trades. You know, last thing I'll say on swing trades is we also always want to keep an open mind. We believe swing trading of the long side generally is easier than shorts. But when the market dictates, we're certainly not afraid to go to the short side as well. You can see an example of that with Chewy. This is one that's in a TTM squeeze, but in this case, the momentum stalled and it started to pull back. And we thought it was really interesting that the momentum stalled at an anchored VWAP level. And as that momentum stalled and it pulled back, we also saw it continue to go down and break through another anchored VWAP level, which is this swing low. And this gave, right off of our weekly watch list, gave a move down from 83 to hit a low of almost 76 today. So just a really big pullback. And again, the more you can find to support a trade, the better. In this case, we also noted from Cheddar Flow that there were dark pool prints on Friday where someone was either buying or selling at 83.39. So we noted on our weekly watch list, if this level really starts to go and 83 breaks, we kind of like this short. If this level is support and we go over 84, it might be interesting for a quick push up to that anchored VWAP. So the tougher the market gets, the more things you have supporting a trade idea, the better, and you're just going to find much more success that way And again, you're going to preserve not only your capital, but also your mental capital if you have these really good risk reward setups for swing trading. So that's our approach to swing trading. And then really the next part of our approach really is day trading. And day trading, we will change based on what's working. But again, you know, we're in, as we look at the market environment currently, we're seeing a market where breakouts are really, really tough. And boy, I love to trade breakouts in strength when you've got a trending market and they're going well. But the fact is right now, as we do our market character analysis, that the market is really not allowing a lot of breakouts to work, and the ones that are working don't give us a whole lot of follow through, unfortunately. So when it comes to day trading, what we've been focused on more is we've been focused more on looking at reversals, and that's another strategy really driven for us by TTM. So I want to talk about a strategy we have, and then we're going to go through a couple examples of it. Let's just go ahead and start with the SPY chart. So this is not the example, but this can talk about what we're looking for. When it comes to reversals, let me just clean that up there a little bit. When it comes to reversals, we really want to see a technical signal, right? So if I look at the SPY chart here, you can see in this case, when we do day trading, we focus on 5-minute charts. You know, this particular chart here just pulled and pulled and pulled and pulled. One could argue actually bear flagged some. So I think a lot of people fall into the trap of, boy, if it's pulled back some, it's a bargain and it's going to bounce. Or if it pulls back to you know, a certain price level, it's going to bounce. We don't want to guess where it's going to bounce. We will watch certainly areas of interest. But when it comes to just day trading a 5-minute chart, we want to let the technicals tell us what's happening and when something might reverse. And the key signal for us is going to be the relationship between the EMA 3, which is our 3-day or 3-period exponential moving average, and that's our green line, the EMA 8, which is our red line, and then the SMA 20. So what we look for typically for our reversal strategy, what we call our gap and reverse strategy, is we look for names that are setting up what we call a 3-8-20 cross. And for a 3-8-20 cross, we need to have a couple key things. Number one, we want to see the 3, our green line, cross up the 8, which is our red line. Number 2, we want to see the 8 cross up the 20. That's the second thing we need to see happen. And then the third thing is, if we look down at the lower part of the chart, we want to see positive momentum on TTM. If I don't have positive momentum in a 3-8-20 cross, then it's going to be no trade for me. To make it even better, we like to see that 3-8-20 cross when I've got positive TTM momentum, which means my yellow bars are either pushing up to the 0 line or my blue bars are pushing up away from the 0 line. And I also have a TTM squeeze. So really simple for us. We don't want to guess where a name's going to reverse. We don't want to guess where a name's going to bounce. We want to let these technicals give us what's going to be, through tons and tons of back testing we've done, what's going to be a really good risk reward setup. So I'm going to go ahead and talk about a couple examples we saw today. And the first one's going to be an example that did not give a trade signal. We'll talk about why, and we'll talk about how important everything is with this. And that's a name that really took a beating. That's FUTU. that gap down, push down, and boy, I can tell you, looking at Twitter today, people were buying the 5-minute SMA 200. People were buying this candle that looked like it was going to be a hammer candle. People were just trying to guess the bottom on this thing all day long. We watched it all day long. But the bottom line is, what we never saw was a clean 3-8 cross with an 8 that came up through the 20. So if we look at this area here, we came really close. We came really close, right? The 3 came up through the 8, price action came up through the 20, but I never had my 8 come up. My 8 never came up, and you know what looked like maybe a good entry for some, we said this doesn't meet our technical requirements, and boy, this thing pulled another about $10 off of that in just a couple of hours. So we think it's really important to manage risk properly, to not get ourselves in trouble as we do this reversal strategy, which is a big part of what we do. Definitely our biggest day trade strategy right now in the current market character are these reversals. And if we don't get clean signals, really simple for us. No trade, we're going to keep our capital, and it helps keep us liquid. And it also helps keep us ready to look for that better opportunity. So we're going to look at another example here. This was another name that was very beat up today. Big gap down, came down again. I think there was folks probably guessing at where the bottom might be, and probably got stopped out in that first candle. We just simply let this play out. We look for our technical signal, and in this case, we got a really clean signal right here. So we'll walk through that. What did we see? Well, we saw the 3 come up through the 8. Right here in this candle, we had that 8 come up through the 20. We look down below, right? Because we want to make sure we have TTM as well. We had TTM, and this is really, to me, the best place to get involved TTM momentum wise, as you're pushing right up through that 0 line and you're going from the yellow bars to the blue bars in this case. So with this, we were able for our members to suggest an entry right around 46.15. And then you can see this just rode up, never even touched its EMA 8, just a really clean, easy trade. Pushed up here until right there, it started to lose its 8, gave us a full $1, no stress, not a name that goes crazy. But if you traded the options, the options were just a little, if you traded some nearer expiration right around the money, weren't much over $1, and you just got a killer return on these. So that's really, when it comes down to it, the gist of what we want to do. We want to have our swing trading strategy. We're going to be more aggressive with that as we have a trending market that allows us to do that. When we don't, we're probably going to allocate less capital, less effort to that. And we're going to focus more on these day trading strategies. And again, that changes with the character of the market. If we have a market where breakouts are great, we're going to focus on those. But I can tell you for quite some time now, these reversals have given much better opportunities than the breakout attempts right now. So thanks so much, Jake and TrendSpider, for having me on, and look forward to being on sometime again in the future.
A big thank you to Peter for going over some of the indicators that he uses on TrendSpider, and really gives him an edge in the market and allows him to adapt to this ever-changing market. That is all for the guests going over their presentations. Thank you everybody for joining. A massive thank you to all of the guests today for going over how they have really navigated the markets and adapted to this crazy volatility and this ever-changing market that we're in. If you have any questions, you can always reach out to us about the TrendSpider platform. If you do want to try it out and sign up, we do have a 40% off coupon code. ACM40 is good for any plan, 40% off a single month or a single year subscription. And once again, thank you everybody for joining on this Sunday. Everybody have a great rest of the weekend, and we'll see you soon for season 4 of the Stock Trading Pit.